morning, Ben. Big Ben in the building. Shout out to you, Ben. Give me a minute. I'm trying to put these plans together, buddy. Team, I don't like none of this. I don't like nothing today. With the SPY, I don't like anything. We at 694, but we got overhead resistance at 696. Two key points is the 696, 689.5. The middle point of that is the 692. So I do like a put below the 692, but I don't really like a call. If I did, I'd take the call now just to retest the 696, but it's clear overhead resistance, so that could be a trap to take it back lower. Just look at it, just a lot of this nonsense right now. Yeah, I was able to make money off of it, but you know, as profits is going to present themselves, but it's nothing ideal. And again, I'm looking for right now obvious setups, and it's nothing obvious right now. Looking at this, there's nothing obvious right now. I got on in that continuation move, it reversed. The bears still have control until you get back above 696. The bears have control until you get above 696. If you're able to get above 696, that's how I see it. As far as with the safe money, the secure money, if you want to make sure you're not going to get trapped, again, the two liquidity points I see are the 696.7 and 689. Being that we already bounced to the 694, if we come back down to the 692, we'll have that momentum coming back down to the 692. So for that reason and that reason alone, I like a put below that 692 area. So I'll go 693 on the strike, 692 on the entry. Probably go 694 on the strike. 692 on the entry. 690.6 on the first profit target. 690.6, 689.5 for the second profit target. If I take a put. And I'm looking at 0 DTE. I'm gonna trust this overnight. For a call, I'll go with the 695 call. I'll go with the 696, possibly 8 for entry. 698.6, 700. So that's what I like for a call. So granted, it's gonna take some time to get there, but I don't like nothing in between that. So I'm gonna switch that over to the other board, to my Thinkorswim chart, and then let's see how that lines up. Okay. On this terrific Thursday. Let's see how that lines up over here. Those plans, let's see how they line up over here. Monday, Tuesday, Wednesday, Thursday. Let's see how these plans line up. Don't like anything this morning, guys. Don't like anything this morning. I don't see anything a little bit groovy yet. Shout out to the team. Bulls still have control of the week, as you can see next to me in this daily candle. Why the bottom of the candle look like it's tall? I can't see something. Why the bottom of the candle look like it's tall? That's great. Why can't I see the bottom of this candle? There we go. Alright, we got that fixed. Okay. That was looking mad crazy. Check the TV to make sure everything is aligned in the TV. As you can see the bottom of the chart and the top of the chart. Okay, cool. Shout out to those of you who are kicking it with us on Kick. Transfer my plans over here, and then I'll shout out the team. I don't like anything. Nothing. Daily chart, top right. 30-minute chart. Go ahead and show a little bit of Tuesday, all of yesterday on the 30-minute chart, 15-minute chart, do the same thing. Tuesday. Okay, we do have a weekly area of support here. That used to be resistance, but is now support. I want to clarify that. Get that at the 694.1. Okay, let's get this 2-minute chart. Any algos for pre-market. Let's take a look. We did have a nice gap up. It's pre-market action. Showing a nice gap up, and then we went chop, 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 chop. So no algos to identify right now either. Let me see how my plans play out on today's big chart. I'm gonna use them even without pre-market. These plans. Like a 696.8. Let's adjust that. We'll adjust that to 696. Break and retest. We'll adjust that to a 696 break and retest. 697.1 as a profit target. $698 as a second profit target. Okay. And then I'm going to put the alarm at the 696. That alarm right there at the 696. Alright, let's look at this put. I said I like 692 for the put. Understandable. $692 for the put. If one of these go off, then I'll put up the profit target alarms. But I don't like either. I don't like nothing. We're in a box. We're in a box. We're in a box. I don't like to see us break out or break down from the box. We're in a box. Bulls do have a little bit of slight favor right now. Keep that in mind. As the Bulls have overall control of the week. So the Bulls do have favor right now. You're starting to see that. Okay, we'll go with that view. Alrighty, let me give a shout out to the team. Team in the building. Alrighty. Big Ben is in the building. Nkosi is in the building. Quiet Soul is in the building. Dr. J is in the building. Todd Macon is in the building. Jerry Lewis is in the building. Jesse Swanson is in the building. And big shout out to those of you who are kicking it with us from Kick. We do appreciate ya. We do thank ya. We're in control of everything but what the market does. And the market is not doing anything right now in a state of indecision. Let's talk about money. Let's talk about it. The market is in a state of indecision right now, in a state of chop. I don't like anything. If you like something, you let me know. But I don't like anything until one of these alarms go off. 696. You can find me in a call above 696. 692. You can find me in a put below 692. That's it. I don't like anything. Let's see what the team is saying. Good morning. Looking at pre-market high and lows, I'm not feeling optimal. So I'm just chilling until my alerts come calling my name. Very disciplined trading. Nkosi, very disciplined trading. Great day. Jerry Lewis shouting out to the team. Those bulls can give up and let it roll back to 670 again. That is what Jesse Swanson is saying. That would be awesome. He said high hopes over here. That would be it. Word up, patience, just like that. Background actor, shout out to you for joining us on Kick. Shrinking Press, shout out for joining us on Kick as well. Alarms are set. Like I always do, showing you my trading view chart. These are the two key point areas right here, and I don't want to do anything until we get in those areas. That's how I feel about them. Let me just go ahead and change the color on them. I don't know what color to put them. Let's just put them yellow. Make them yellow. It's not quite yellow. Orange. All right, we'll make them orange. Everything else in between the 696 and the 690 is just a little bit of chop. Now that's a lot of swing, so it's a lot of good scalping opportunities, but the market has not yet decided a direction, is what I'm clarifying and saying. So until that happens, continue to be patient. If you see an opportunity, take it. Looking at the larger time frames, there is a beautiful put opportunity on the horizon right now. There is a nice put opportunity on the horizon. First 5 minutes, very volatile. First 15 minutes can trick you. However, going into that beautiful ORB The bears are getting active right now. The bears are getting active. The bears are getting active. I want to see just a little bit more before I decide to participate, but I got my alarm set. I'm looking for some action around my alarms. No place else. Beautiful scalp on the horizon right now, but still keep in mind the bulls have control overall. So don't get used as liquidity. Okay? Take your time. Don't try to outsmart the system. We now live in a world where you have to pretty much believe none of what you hear and only half of what you see. Seldom. Never thought we live in a world where you can only believe half of what you see. So don't believe. Don't believe just yet. Give it a little bit more time to really show you that that's what it means. I'll be checking back with you guys closer to 10 o'clock. It's time for a cuppa. Suggest you get one too. Some real change. And Kelsey, I feel you, buddy, man. Ain't nothing here either, man. I'll probably look back towards the afternoon. You did? Thank everybody for tuning in. And keep it tight. That worked perfectly, team. Beautiful trade. 692 all the way to the 689.5. Beautiful. That worked perfectly, team. We put together the plan live as we do every day on this channel. I can't thank you guys enough. Some real change. My goodness, I can't believe it's still going. Oh my goodness. Well, I do have a line here at the 688.2. There is a line here. So I'm not surprised as we come prepared. Guys, the beautiful thing is we can do this every day, guys. Every single day. Just about. We come, we put the plan together, just rewind the tape. Every day I put the plan together live right in front of you guys. Then, not only that, I then come to what? I come to my trading view, and on trading view, I'll show you guys also on trading view exactly where I want to get in as well. Everything is completely transparent on this channel. I don't hide anything. I share exactly where I'm thinking, where I want to get in at, and the like. And I even show you guys on my chart as well. Here's the trading view chart that we drew earlier. Bam, just like that. Showed you I want to get in at the 694. First profit target was the 690 and then the 689. Told you I didn't want to get into a call unless or if we got to the 696. And if you look at the chart, there's still an alarm right here at the 696. So I had an alarm there at the 696 to alert me if that call was going to take place. It didn't. So that's why we come up with plans for both directions. One for a call, one for a put. Typically, one will not work, one will. And that's just how it is. Now, no one knows what the market is going to do, so I can't and couldn't anticipate all of this drop, but it is what it is. Shout out to the team and the fact that we have the ability to do this every day. The Bulls also just lost control of the week as well. The Bulls have also lost control of the week. I repeat, the Bulls have lost control of the week. Not a drill. I gotta learn how to hold more. Goodness. And I understand exactly why this is happening. I'm gonna tell you where it's going to. My goodness. Somebody tell me where you think this is going to. I'm gonna tell you where I think it's going to. You tell me where you think it's going to. Based upon the information that the chart is giving us. I'm not out here doing no guessing. It's a measured move here. And I didn't take that into account because of the Bulls being caught up in a potential measured move here. My goodness. My goodness. We're coming down to the 686.7. We're coming down to the 686.7. I did not do my work correctly. I apologize for that, team. We are coming down to the 686.7. There's nothing they can do about it. They can't stop it. It's a measure move. There's nothing they can do about it. I put an alarm there. The bulls are covering. My goodness. The whole story is in the daily candle. The whole story is in the daily candle. It's going there. The alarm is going to go off. You see, I'm talking a whole nother dollar from now, and I'm telling you it's going to hit it. The story is in the daily candle. Right? The story is in the daily candle. In this move that we had yesterday, okay, that trade that we called yesterday, that put that we made yesterday, that we made some nice money on yesterday, the bounce at the 690 was so full of bulls, right? With the anticipation of finally getting that push to test the 700. So with that bounce being so full of bulls, right? With that bounce being so full of bulls, in this tail, right? Forget about this color. There are bulls who are trapped, okay? So now with the price reversing today, all of the bulls that you don't see now have to cover. And they have to cover. That is what is creating this extra measured move. So we knew the anticipation to the 689.5. That's why we called out the 689.5 as far as the profit target, because we could very easily see that 689.5. What we did not take into consideration is the $2 more it would drop with the bulls from yesterday having to cover. Let me identify them. Here they go right here. I want to blow it up. I want to get bigger. Let's blow it up. These bulls right here, I want to get bigger. Because I might have already drawn it. I wasn't exact. Okay. Okay, that's it right there. You take that measure move, duplicate it. Yep. 689.7, we came down. 686.7, we came down to the 686.8 for a little small bounce. That's still the same area. Still the same area for that measure move. Because if I was going to put a box here, the box would be like so. You did? So it would still qualify. So I missed it because I did not take into account the bulls that were trapped from yesterday's bounce. Didn't take that into account. If we would have took into account the bulls that's trapped from yesterday's bounce, that gives us the measured move down to the 686.7 area. And I'm saying area because nothing is exact. Everything is area, but still it's $2 more. We're not going to talk about the cents that I'm off. This is still the area. Fact of the matter, it's still the area. And I missed it. Oh, there it goes right there. Bam. Right there in your face. I missed it because I didn't take account the move of these bulls yesterday. Right? Remember, we made on this yesterday. We got in at the 694. We got out at 692. We got out at 691. She came down to 690. This white line that I keep telling you guys about this white line. The bulls came back in. I forgot to take them in consideration with this move coming down, with them having to cover, which probably also means she's probably not going to go much further than this line right now where I got her. I'm going to go ahead and put some color on it, and I'm going to turn it green. This is probably about to be an area of support already. That's probably going to be an area of support. Okay? Very clearly, very easily. Very clearly, very easily. But nonetheless, because of the fact I didn't take this into consideration, we missed out on this move. So we saw the 692 to the 689.5. But we still didn't take into consideration once we got to that area, if the bulls did not come back in the market again and buy it up like they did yesterday, they would have to cover. They're covering being a measured move. The measured move brought us down to the 686.7. We'll get better. We'll get better. We'll get better. We'll get better at holding. We'll get better. Big Ben said, now that it is support, I need to take care of a call. I'm in at the 693. I don't know what you mean on that. Oh, my goodness. Yeah, right? I'm looking at the guys. Yep, liquidity between 688, 683. MYM is saying 687.5. Big Ben, Jesse Swanson, premature exit for me too. Tomorrow setting in. Yes, sir. Now that it is support, I need to take care of that call. Yeah. Well, let it formulate. You know what I'm saying? You know, no one knows where the chart is going. You know, and I'm one of the biggest people to say that. So please don't allow my enthusiasm. Don't allow my reading what the charts is showing me anyway to come across as if I'm trying to act like I know what the charts is going to do, because that I do not, and no one does. This thing could keep on going and completely ignore everything that I just said. Okay, I just had the ability to see what the chart is showing me, and I share that information with the team. Sometimes I'm right, sometimes I'm wrong. It is what it is. It's called trading. We deal with probabilities, a higher set of probability over another. We deal with ifs and then. If this happened, then I'll do that. If that happened, then I'll do this. We deal with if and thens. We deal with areas. We deal with high probability of one thing happening over another. Okay? We deal with losses and we deal with wins. Okay? Everybody wins. Everybody wins. Okay? The key is when you lose, how much do you give back on your losses? That is what determines how profitable you will be. So I'm going to say it again. Everybody wins. Everybody wins. The question is, when you lose, how much do you lose? How much do you give back? That is what makes you profitable. Simple math. Simple math. Addition, subtraction, simple math. Okay? So what we focus on is minimizing our losses, minimizing our exposure by being patient. The more impatient you are, the more you're exposed to the market. The more you're exposed to the market, the more you typically lose. The more patient you are, you're in a position to allow the market to unfold, to allow setups to present themselves, and then you can pick your shots. We're never going to be able to nail the market from beginning to end. We want to see a pure trend happening. We want to verify and see our move happening on a larger time frame. We want to understand why it's happening, who our money is coming from, meaning who's taking profit or who's covering, because fear and greed is the only thing that moves the market. Where this area is going to take place at, and once we identify where that area is, then we lie in wait and we patient. It's just that simple. This was a beautiful move here. And somehow I did not have my calculations right. Great day, grateful day, team. Man. These are one of those days, even when you do good, you feel like you ain't done nothing. Damn, I'm done.
So an extended it's going to be a big, huge reckoning. And the number one question that's going to be asked is, how much software exposure do you have as a lender? That's the number one question everyone's going to ask.
But also, how much worse can it get?
It's going to get a lot worse because we haven't seen anything really collapse yet. Now, you look at the broadly syndicated loan market, which doesn't have as much of a problem as the DL market, and 1/3 of all broadly syndicated loans that are distressed, price distressed, is software. So it's only now starting. The repricing just started, Carl and Sarah, in the last few weeks. And so it's going to take some time to play out. There's going to be three types of companies. Companies going to prosper from software. The software companies going to prosper from AI. Creative destruction makes them stronger. Those that kind of have a moat that's going to be encroached upon, but they'll survive. And those that have a difficult time and probably don't survive this big development that's happening.
Right. So what brings about that would-be collapse? Is it revenue misses or?
It's the debt. At the end of the day, for these companies, when you have 10 times debt to EBITDA, it's too much debt, Carl, relative to the enterprise value. And so there needs to be a restructuring.
So it will be a balance sheet discussion, not a income statement discussion in the next, what, 2 quarters, 3 quarters?
Well, I think it's going to play out over years because when the maturities of the debt comes up. Right now, there's enough cash flow for most of these companies to service their debt. No one will refinance with that kind of debt outstanding. So the next lender is going to only lend 4 or 5 turns, not 10 turns. And so who's going to put up that equity? And a lot of that equity is not there. It's the private equity that owns the 5,000 software companies around the world are all getting re-rated. And the reason why they traded at 20 times, this is really key. Every PE firm looks at buying companies and they buy them at 8 times and 10 times and 12 times, depending upon their growth and their earnings and their margins and the quality of their business. And every business is different, they're willing to pay different multiples. But they're all in the range of like 8 to 12, generally speaking. There's only one industry that's a major industry that was at 20 times. And everyone convinced themselves because of ARR, because these annual recurring revenues,
sure,
that you can value the company at 20 times because there's this moat around it. Well, guess what? AI encroaches on that moat, and that moat may not be there. And so this is an industry that's going from trading at 20 times to 10 times. It's really just that simple. And so how much debt can a company that trades at 10 times PE multiple support? And the answer is probably at a 50% LTV, probably around 4.5 to 5 times.
Yes. So, I mean, you just, what was it, 23% of the private credit market is software? So that's why these stocks have been out of favor, the Apollos and KKRs and Ares.
Well, I don't want to comment on anyone's stocks, but, but the average private credit lender out there. You know, Marathon has a DL lending business. We have an ABL lending business. We have an opportunistic credit business. Do you know what our exposure is to software? It's because
None, because you've been warning about
it. It's 1%. 1% of our private credit business is exposed to that, where I think when you look more broadly at the lending community and the private credit business, that maybe didn't see where the puck was going and didn't see this train coming down the train track, which should have been identifiable.
But was your concern about valuation alone or because of the encroachment of AI?
Both. 20 times multiples is a lot, and since when, over the last 10 years, do we all come to agreement that you can lend any company 10 times debt because of this recurring revenue. And the model itself may change because it may not be recurring revenue for the software industry as AI takes on and people use tokenization and burn tokens for, as opposed to the annual take that they pay on, on that software delivery.
We have to talk about the most important deal since you've been on, which is, of course, the sale of your business, Marathon, for $1.2 billion to CVC. People are, when a big credit manager like you sells, everyone's wondering why now? What does that say about where we are?
Yeah, so it says nothing about that. In fact, we look at CVC as the best the best private equity manager in the world. KKR was the first private equity manager really in the United States in 1976, I believe, when Henry Kravitz formed that firm. And, CVC just came a couple years later, has 1,350 employees around the world, 30 offices, managing $240 billion of assets, and is a phenomenal private equity manager with an infrastructure business, with a secondaries business, with a European credit business, and we are a perfect fit for them. I think they recognize that. We recognize that. And so this is
it's not like the top for private credit?
This is an opportunity for all of our partners, every one of our partners, to join CVC, all of our firm to join, and no one's leaving. It's the same exact investment program with the same exact investment team, managed by the same two managing partners, Lou Hanover and myself, as the CIO and CEO of the firm, leading Marathon's credit business forward. So it's a perfect fit. CVC's, we believe, is the best private equity manager in the world, and so it's just an honor and a perfect combination, a powerful combination for Marathon to join forces. And so it says nothing about that implication. It says everything about our confidence in this great organization being able to deliver clients our full suite of package of what we offer, including U.S. and global credit.
Well, congrats on getting a deal.
Yeah.
Deal done. Thank you, Bruce.
Thank you.
Always good to see you. Bruce Richards of Marathon.
Still ahead this hour, the CEO of AWS is with us with more on the company's ambitious CapEx plans. Stocks down double digits to start the year. Plus, turnaround effort underway at Saks. A new CEO is going to join us in a few minutes as the Nasdaq's down almost 2%. Stay with us.
Welcome back. Saks Global making a number of announcements to restructure its business, including closing 8 Saks Fifth Avenue stores, 1 Neiman Marcus store as well. That's after the company filed for Chapter 11 bankruptcy in early January. Joining us in his first interview as CEO, Geoffroy van Rendonk. He's the CEO of Saks Global. Geoffroy, thank you very much for joining us today. So you led Neiman Marcus for a few years until Saks acquired Neiman. Why did you decide to come back in and take on this bankruptcy?
Well, I have a real belief that this business has a reason of being, and that having led Neiman Marcus Group for 7 years, I was very much the right person to help this company realize its full potential. The merger brings together 3 different department stores that have a reason of being because we have 30 million active customers and we have incredible sales associates, 1,800 selling 2 million in average. And so that's what I'm here for, is bring the company to profitability and stability.
So wait, I mentioned the store closures. What else are you focused on, just on the cost cuts, on right-sizing the business so that you can lay a foundation to get back on track?
So when you are in a Chapter 11, you have a process that is structured and provides you flexibility and provides you access to tools that can make decisions. So the decisions we are making is closing stores. We've announced 9 closures of stores that were small, for the most part not profitable, and in markets that were quite small and where we didn't think that there was long-term potential for growth. We've also made a commitment that we are focused on luxury, and so we are winding down our Saks of Fifth business. And then we're taking some other adjacent decisions, such as we had standalone Fifth Avenue clubs in location where Neiman Marcus was operating, and now that we have the merger, we don't need these to the same extent, or we are transitioning Horcho, which is a great home business that we have, to redirect to our core Neiman Marcus home business. And that's all in the eyes of building a business that is profitable, a business that is focused on retail and not on non-core assets or on real estate.
I mean, it makes sense to focus on luxury right now, given everything we hear and see on the luxury consumer doing so well, being so resilient, getting exposure to the stock market, which is doing so well, which makes me wonder, Geoffroy, what happened here? What went wrong? Why Saks couldn't pull it off in this kind of really strong environment?
It's a great question, Sarah. I think what happened is a lack of liquidity, which put pressure on the operations. When you don't have liquidity, you don't pay your vendors, and ultimately that combined with a lack of transparency in communication led in having less inventory. And the blood of our business, the flow and the energy of our business is selling products. And so the lack of product really led to a downward spiral in performance. But that's now to an end in a sense that with the filing, we have access to 1.75 billion of committed capital. $500 million we already have access, and 750 million of additional capital for a total of 1.25 billion will be accessed within the next 30 days. And so that problem now of being able to pay the brands and access the product for our customers is one that is being resolved.
It is an interesting opportunity, I guess, to sort of reshape. My question is about the physical footprint of department stores and retail, and whether or not in the future, Geoffrey, that becomes what? More specific, more specialized, smaller, bigger?
I think what customers want is going somewhere where they can have an experience. So most of our stores have restaurants, they have additional service that are provided, and they want the stores to complement their experience online or in remote selling. What's unique about our stores is the sales associate. As I mentioned, we have 1,800 sales associates who sell more than $2 million on top of all the others, and we make and realize almost $3 billion in revenues with those sales associates. These customers have a relationship, and we have a relationship with them. We know them, and I think that's really the future of the store, is to be the place where you meet with the person who's giving you the advice of what's right for you. The footprint will be smaller. We need to be in the markets that are big enough. We need to be in the markets where our stores are profitable, and then that will depend on the market. There's markets where we have 2 very profitable stores, and they'll continue to exist in the name of Saks and Neiman. We'll differentiate them. And then there's markets where the stores are small, or one is significantly bigger than the other one. And in that case, the customer has voted in terms of which one is the one to go forward. But it's important for me to keep the strength of the brand of Saks and the strength of the brand of Neiman Marcus. And obviously, Bergdorf is unique and is here in New York.
So how long is this going to take, Jeffrey, to try to turn it around, to repair relationships with vendors that you mentioned, and bring in customers for an experience, which is a challenge? I mean, I don't know, is there any department store that's doing it well right now?
Well, when I left Neiman Marcus, we were a profitable business with 350 million of adjusted EBITDA. So there is a way to be profitable. I think the first step is the one you mentioned, is to rebuild the trust with the brands. I came back with two of my former colleagues, and with the great talented merchants we have and the access to the liquidity, we are fast and furious in rebuilding that trust. And we are having and have earmarked $500 million of inventory at retail that is going to start flowing to our DCs and to our stores for the customer. So that's one element. And then this process is one that we expect to exit later this year. And there's a lot of steps there, but the strength of what we can do, because there's tools available during the bankruptcy that allows us to refocus, that's what's going to take some time to make sure that we put and maximize these in place.
I would like to request food halls. I think it's so fun to go to department stores overseas, in Japan and in the UK, because of the food halls. Why can't we do that?
We have restaurants and cafes, so I think we probably have 50 to 70 restaurants and cafes, depending on how you count the cafes. I think food hall is a great element, because I think what you're touching on is this desire for experiences. The customers is shopping and they want to buy a product, but the experience of the shopping is really part of what they want. And so there's more to come. The first step is a profitable business poised for growth, but then there's a phase of transformation where we reinvent what it is to go somewhere for discovery, and discovery of product, but also experiences and food, and more than that.
I know, the only way I could get my kids to go to Harrods was the chocolate hall at the center of the food hall. Jeff Roth, thank you very much for joining us on the new job and on the challenges ahead and how you're looking to do it. We appreciate it.
Thank you, Sarah and Carl.
When we come back this morning, CEO of Amazon Web Services with one of the company's first interviews since laying out those ambitious CapEx plans. Stocks down about 17% for the month to date. Stay with us. Getting some breaking news from Washington. Let's get to Eamon Javers on that. Morning, Eamon.
Good morning, Carl. We've got a significant shakeup at the Trump Department of Justice happening at this hour. The Department of Justice is saying that the head of the Antitrust Division, Gail Slater, is departing the Department of Justice. Now, this could have some bearing on that big Ticketmaster case that is coming up in front of the Department of Justice. And we've got some statements here I want to read you. This is from a Department of Justice spokesperson saying, on behalf of the Department of Justice, we thank Gail Slater for her service to the Antitrust Division, which works to protect consumers, promote affordability, and expand economic opportunity. We also have a statement from Slater herself on X. She says, it is with great sadness and abiding hope that I leave my role as AAG for antitrust today. It was indeed the honor of a lifetime to serve in this role. Huge thanks to all who supported me this past year, most especially the men and women of antitrust. So statements here from both sides confirming that Gail Slater is leaving. There's obviously a significant backstory to this, Carl, which we will dig into. My understanding at a very superficial level in the first couple of moments here is that there were significant tensions between Attorney General Pam Bondi and Gail Slater's side at the Department of Justice Antitrust Division, and questions about how antitrust cases involving big corporations should be handled. We don't have all the details yet. The Financial Times broke the story just a short while ago, and we are endeavoring to find out more about what exactly went on here and what it means for big companies that are dealing with antitrust in the Trump era, guys. Back over to you.
Yeah, the FT does talk about her sort of comradeship with Vice President Vance, advocating for tougher scrutiny of corporate power, but that the FT says he has not publicly at least intervened on her behalf. Eamon, thanks. Eamon Javers.
You bet.
All right, Amazon's down again, 8th day in a row. Investors showing some concern after the company announced plans to spend $200 billion on the AI build during that last earnings report on Thursday. For more on those CapEx plans, we are joined by CNBC's John Fort, as well as the CEO of Amazon Web Services, and a CNBC exclusive. John, over to you.
Sarah, thanks. Matt Garman, good to see you. First after earnings. I guess I saw you in San Francisco a few days ago, but first time on TV. $200 billion is a lot. Granted, it's not all going to AI, but the lion's share of it is. When we last talked 6 months ago, I think Amazon was getting criticized for not spending enough here. So tell me how your plan for this spending you think is going to give you better long-term value.
Well, and thanks, John, for having me on. It's nice to see you again. Yeah, so for us, I'm just as bullish about the AWS businesses as I've ever been, frankly. And this last quarter, we reported 24% year-over-year growth on a $142 billion run rate, and very bullish about how we see customer demand. And as I talk to customers out there, every single customer is seeing more and more demand for moving their workloads to the cloud, putting their data on AWS, and then layering AI on top of that to get value for their business. And so we see demand increasing across a broad set of our business. And remember, for AWS, this demand is not isolated in one or two customers. We have tens of thousands, hundreds of thousands of customers that are driving this demand, and all of them are growing pretty rapidly as they're thinking about how they deliver more value to their business. And so we're incredibly bullish on AWS's growth over the next few years. And the $200 billion in CapEx spending, that's to invest in that future for those customers to be able to land their workloads in the cloud, for them to be able to ramp up. We need to build data centers, we buy servers. And so this is an investment for us. It's obviously a large number, but it's something that we think is a really great investment, and it bodes. It's an indication of how bullish we are about the future and the growth of AWS.
Matt, investors are trying to figure out how to measure this horse race between the various hyperscalers, of which you are one, Microsoft, Google, and sometimes others counted in that. And there's a percentage growth. There's also the dollar growth. You guys are big, so you move more with each percent than the others do. But what are some of the metrics beneath the surface that you're looking at when you gauge how well you're stacking up competitively with the others? When you're talking to your team, is it those percentages? What is it? The type of business you're winning? What is it?
Yeah, it's a couple of those things, I would say. One of them is we definitely look at that diversification of business. We're very focused on how do we get all of the largest enterprises in the world, how do we get all of the startups in the world building on top of AWS. And so there's others that have some growth that's very concentrated in some of these very large customers, and we have many of them, the OpenAIs, the Anthropics of the world building on us as well. But we're also, I think, for the long-term health of the business, very focused on how do we get every single startup out there building on top of AWS? How do we get every bank? How do we get every healthcare company? How do we get every retail company? How do we get every manufacturing company building on top of AWS in the cloud? And so for that, and there we see AWS winning the vast majority of those times. And as you mentioned, AWS is much bigger than some of the other competitors in the field. And so the percentage growth rate is lower, but in an absolute growth rate, if you look at the absolute dollars added last quarter and the quarter before that and the quarter before that, AWS was bigger than everybody else. And so we continue to grow in absolute dollars faster than our competitors do. And then that's part of it because we are winning many of these workloads, and we continue to see more and more customers accelerating their migration into the cloud.
So I also wonder how much to think about what the various players here are selling. Are you reselling partners' technology? How much of your own technology are you selling into these customers? To what degree are they growing on you as a platform? So when you look at the chips that you're developing, Trainium, Inferentia, et cetera, when you look at Bedrock and customers building their own customized AI strategies on top of that, to what degree do you think that your growth in those areas stacks up better than equal to your rivals?
Well, look, we think about, whether it's our technology or partners' technology, we've always, from the very beginning of AWS, felt that entire ecosystem is incredibly important for customers. And so we build a lot of great services in AWS. We build an underlying technology that is the platform that most of those companies rely on. But from a chip perspective, unlike some others, we mix in key top chips from Intel, from AMD, and from NVIDIA with our own technology. And so, and that own technology, we've been building our own chips for 10 years. I think it adds choice to our customers. It adds better price performance for customers and really helps the whole business grow faster. And so today, more than half of the chips that we land in AWS on the compute side are Graviton. If you think about Bedrock, which you mentioned, which is where the vast majority of enterprises are now launching their production AI applications, not just their kind of proof of concepts for their production applications. They're often launching those in AWS on Bedrock. And more than half of the usage of Bedrock is driven by Trainium chips, which is our own AI chips. And so we're really seeing this benefit up and down the stack, where many of those workloads are also landing on NVIDIA, also landing on Intel, also landing on AMD. But the Amazon-built chips really help us deliver a differentiated price performance for customers.
Speaking of usage, there's big concern in the market right now about the future of software, maybe most specifically a lot of application software, systems of record. There's concern that the AI wave that's cresting right now is going to allow some of these AI platforms to create interfaces to really replicate the work that some of these legacy software companies have done, really take value away from them. Also that the subscription seat-based model in software is crumbling. Amazon's in a unique position, both as a huge user of software and as a platform that a lot of this is running on, to see what's really happening and get a sense of what's about to happen. How real is that shift in business model, and is that shift in use of software? Is your team using less application software than you were? Where's the value?
Yeah, well, I would say, look, my own opinion is that much of the fear is overblown. I would say, look, many of there's a huge disruption. AI is absolutely a disruptive force that's going to change how software is consumed and how it's built. And I would argue that the systems of record, as you call them, the SaaS providers and the large players of today have an inside track to winning that business. Now, they have to innovate just like the rest of the world. They can't stand still. If they stand still, they're absolutely going to be disrupted. But if they're innovating, if they're leaning into to AI, and they're thinking about new experiences that they can deliver to their customers, they have an inside track of winning that business from those customers. And so, I think there's a lot of change that's going on there, and I think that the way that we consume SaaS products will probably be different 5 years from now, just how the way that we consumed packaged software changed when we moved to SaaS offerings. And so that change I for sure am seeing. It's possible that the model of per seat licenses will change to a more usage-based pricing. It may change to some other type of licensing. We don't really know kind of what that new model or how those companies are going to think about that new model. But I think that the thing that's not going to change is, from our perspective, is that our customers are going to consume more compute technology and more infrastructure than they ever have. Whether they run it themselves, whether they build it on top of AI, whether they buy it from SaaS vendors, whether they have some mix of that, from an AWS perspective, customers are still going to need to use more of their AWS infrastructure, whether they're building it yourself or from partners. And we're focused on building all of the building blocks so that no matter what and where the industry goes, it can be built on top of AWS.
We appreciate the insight post-earnings exclusively from you, Matt Garman. Thank you, CEO of AWS.
Thanks, John.
All right, thank you, John. Going really deep. Up next, the biggest players in AI are taking sides in Washington. We're going to take a look at the battle shaping up between Anthropic and OpenAI. One of those companies just announcing a new multi-million-dollar super PAC this morning. That's when we come right back. Political battle lines now being drawn in the AI industry. Anthropic announcing today it's donating $200 million to a super PAC that supports putting more guardrails around the technology. Deirdre Bosa has more in today's Tech Check. So they're not just spending on data centers, Deirdre.
Not just data centers, but this certainly does relate to the ability maybe to build data centers. But what we're talking about right now is AI's internal safety civil war. That's going public. You've got Anthropic on one side arguing for guardrails on everything from kid safety to chip exports to China. They just put $20 million directly in their own name into a super PAC that will launch ads for pro-regulation Republicans, and it plans to target 30 to 50 races in both parties this cycle. Now, on the other side, we'll get over to it, a coalition of AI's biggest players, OpenAI co-founder Greg Brockman, Andreessen Horowitz, Palantir co-founder Joe Lonsdale, they have poured $125 million into a PAC called Leading the Future. They want a single federal AI standard that would override state laws, and they have the White House behind them. Now, a few years ago, guys, this would have been a sideshow. AI was all promise and very little pushback, but that is not where we are anymore. Just this week, an Anthropic researcher quit, in part to write poetry about, quote, the place we find ourselves. Two OpenAI researchers, they also left this week, one citing ethical concerns and another posting on the way out, I finally feel the existential threat that AI is posing. And then xAI lost the co-founder who ran safety. Now, yesterday, a former OpenAI safety research published an op-ed in the New York Times warning that putting ads in ChatGPT is the Facebook playbook all over again. But I want to stress, this isn't just talk. OpenAI has also dismantled its mission alignment team, which was created to make sure that AGI benefits humanity. Anthropic published a report showing that AI can now be used to create chemical weapons, and xAI is part of that reorg. There's now no dedicated safety function. So what's driving all this fear is that models are starting to improve themselves. This is a line that safety researchers have been warning about for years. And OpenAI's latest model just crossed that line. You've got AI building AI. We have entered.
What sort of other issues are they pushing for in Washington? Because as I've been saying, there was a lot of talk in Davos, for instance, about how they're going to have to be a lot more political and all-inclusive when it comes to this AI thing taking over all of our lives.
Right, it's been kind of an interesting cycle. I mean, I feel like when we first got ChatGPT, there was talk about safety, but then it was framed as the U.S. versus China. If we don't go fast enough, they're going to catch up. But we're back to this moment where, those that are arguing in favor of regulation are looking at things like kid safety and those exporting, chips to China. So there's a lot of different facets of this.
Dee, thanks for that. Deirdre Bosa, as we're down a full percent, VIX above 20. Let's get to the judge at Post 9.
There will be all over that, Carl. Thank you very much. Welcome to the Halftime Report. I'm Scott Wapner, front and center this hour. The so-called old economy market, why some say that rally in many areas outside of tech still has legs, maybe long ones too. We will discuss and debate with the investment committee. Joining me for the hour today, Josh Brown, Kerry Firestone, Malcolm Etheridge, and Jason Snipe. We'll take you to the wall, show you what's happening here on Wall Street today. 1% decline to at least across the board. The Russell almost 2%. So, we're watching all of that. Well, Goldman Sachs today says equities are likely to remain the best performing asset class. Just use that as the jump off point. One day doesn't anything make, right? The trend has been up, and many think it's still there. And what's interesting to us is that it has been led by the old economy stocks. The Dow Transportation Average outpacing the S&P over the past 6 weeks. Trends developing here, right? 6 weeks doesn't make a longer term thing, but you got to like what you see if you are a Dow theory fan, if you are in the transports, if you're in the industrials, Josh, because that's where the action is focused.
Yes, and we're replacing old economy with Halo. And in fact, I insist upon it because it's not about, there are a lot of old economy stocks that you do not want to go buy. You don't want to buy newspaper stocks. So it's not old versus new. It's which companies have assets that are heavy, they're meaningful, and can't be replicated by something in software, in information technology, in data, in services, in white-collar professional services. So it's very important that we all understand this litmus test because that is literally what's playing out on the screen right before our eyes. If you aggregate every stock in the S&P materials, energy, real estate, utilities, industrials, and staples sector. Just take those sectors, and it's a lot to choose from. The median RSI for those stocks is 67. All of them have momentum. The median percentage below the 52-week high for all of those stocks is 4%. Think about that. They're all making highs. 87% are above their 50-day moving average. So not only are they making highs, they're breaking out. This is where the money is going when it gets ripped out of CRM, when it comes out of ServiceNow. It's not old new, it's not value growth. Those are old paradigms, they're anachronistic. They do not describe the ways in which allocators are making decisions. What they're deciding today is, am I gonna wake up tomorrow and Claude can do blank? And this is why it's really important. And then I'll pass the mic. You have to look inside of sectors and you can see this dispersion. It's unbelievable. Delta is Halo. You can't code yourself up a plane. I know you'd love to, and maybe someday you can. The plane is the plane. No obsolescence risk at the moment, and certainly not disruptible. However, in the same sector, Expedia, unfortunately, highly disruptible. You can have an LLM right now tell you where to book your tickets, where to book your hotel, and within 90 days, you'll probably be able to have the LLM actually book it for you, completely bypassing Expedia. So we can't say that travel is not disruptible. We can say Delta's not, but Expedia is. Therefore, Delta is Halo, Expedia is not. And just look at the divergence in the charts. Don't take my word for it. You see this sector by sector by sector, large cap, mid cap, small cap. This is the constant.
Yeah. I should note that the transports today.
They put it up, Scott.
They did. They did. They're good. They're good. They almost beat. They hear you. They follow you. Nice job, guys. Transports are getting crushed today, okay? I don't want to ignore that, but you know what's been happening lately. And that's why people like Ed Yardeni continue to overweight those names. The industrials have done well. It's hard to look at the tape of the Dow industrials today down more than 1%, down 500 points, and say, what's he talking about? But I mean, you guys know what the trend has been. It's 50,000 on the Dow. You got there for a reason. Yeah. And Jason Snipe is buying more Eaton. Yeah. So that's a play on kind of everything we always talk about, right?
There's no doubt about it, Scott. And I think Josh kind of points out a lot of the points that I think are driving the old economy, right? So it's electrification, these mega trends, electrification, energy transition, infrastructure spending, digitalization. These are all the places that Eaton sits. I bought this stock. I'm relatively new to the stock. I bought it August the 22nd last year. There was a little bit of a fallback. It was kind of in a steady uptrend in the first half of the year. I kind of bought it on some weakness. Then it went down, right? So that obviously doesn't feel good. But this year, in terms of equipment heavy, industrial type of names, you're seeing the trend upwards, and it's up 24% year to date. So we decided to add to our position last week.
Malcolm, you have no ownership in either the areas of transports and industrials. You just tell me why. Why are you avoiding that area?
I don't love old economy as much as these guys do. I completely understand the notion that AI can't disrupt an airplane out of the sky, it can't disrupt earth-moving equipment at construction sites and things like that, but I think there's a ton of opportunities being created right now in the software space and the tech space that are probably being ignored. Some of them are old tech, and I think that's where the opportunities are that I'm more interested in than.
Carrie, got some exposure. Lynn, WabTech, Waste Connections.
Yes, so I think it's important to have diversified your portfolio if you are heavily invested in tech and communication services, and we've said that for the last couple of years, even though it hasn't really worked. But let's remember that owning some of these industrials, and WabTech, which has been a fantastic stock for us and had really strong earnings, is sort of suggesting that UNP, one of their big customers, might be pulling back a little bit on their capital spending this year. I mean, the stock has continued to go higher, but the risk with some of the old economy, such as Delta as an example, is that maybe they don't make money, they lose money. Maybe the stocks get very expensive, or people just sell them because they're extremely volatile stocks, and that has been true through history. You have to be careful about just moving out of growth and moving into.
I couldn't agree with you more. And a really great example this week was Coca-Cola. So we wrote it up for our best stocks in the market column at CNBC Pro on Monday, and we said, do not buy it. Yes, it's undisruptible. Yes, we understand that's why it got swept up in this wave of popularity. But at the time we wrote it up, it was an 85 RSI. So we said, let it cool off. Not that I predicted the earnings. The next day, they reported a good quarter. The stock fell 6%. That was your chance to reload, and now here you go. Coke back to making a new high. We can't just indiscriminately buy stocks because they're not disruptible, because let's remember, those aren't the only risks. Right. We have economic risk, right? We have consumer risk. We have risk no matter what stocks we buy. There is not a segment of the market that's not risky. We're talking specifically about disruption risk this week as an investment community. But it's only one of many risks.
So Piper Sandler today says, quote, we're witnessing a distinct passing of the torch as sector rotations intensify and capital shifts from growth to cyclical and value names. Now, you obviously can see the passing of the torch in the performance of many of the mega cap names. There's the note. Let's show you the performance, at least on a week basis. All right, so NVIDIA's had a really nice snapback. Remember when we were out in California last week, we were going to say to Jensen Huang during the interview that we had with him, man, your stock's down like 10% in the last few days. And then, of course, it was up 7% by the time we sat in the chair, so that didn't work. And then the stock on Monday had a big follow through, so it still didn't work. And that's why it's up now 10% over 1 week. And Microsoft is trying to get something going after virtually doing nothing. But I'll tell you what, look at Amazon. Okay, 1 week, Amazon down 11%. Let's look at it live now, because it's been down 7 straight days into today. The longest losing streak was 8 from August of 2019. So we're chasing history in the wrong direction. For a stock that over the last year, let's show the last year, has done absolutely nothing. It's just disappointed people. There it is, right? That shows you what it's done. Now it's down 12%. But in calendar year 25, it was a nothing burger. It was almost exactly a zero gainer. You own Amazon. What's going on here?
I think when they came out and said we're going to spend $200 billion in CapEx, it caught people by surprise. I know everyone was expecting big CapEx numbers, but this is like in the cartoon when the safe drops on the coyote, you think it's over, and then a piano falls. And if you're an investor in this stock, there's 2 things can be true. One, it's been a good bet over the last 30 years to trust what they're doing on CapEx, because eventually the cash flows come through, and you just have to believe that they know better. The problem with that is they did not know better at the rate that they were spending in 2020 and 2021. They hired 1 million too many people. They spent 3 years working off that excess, and it has not been an enjoyable ride for shareholders. So right now, I think there is a very legitimate question. Yes, we know you can spend $200 billion. Are you definitely going to spend it in such a way that by Q3, Q4, you can point to an ROI and say, hey, this is making sense?
I mean,
people don't believe it.
You had the head of web services on literally in the last hour with John Fort, who obviously asked him about the spend, and he, like everybody else, continues to be bullish about it and justifying. Everybody on the desk owns it. We can go right down the list on what you think about this now 8-day losing streak, a stock that's done next to nothing over the last at least calendar 25 and is off to a bad start yet again.
Yeah, I think what we're seeing is this wholesale selling of these stocks, either because of CapEx or because they just happen to be in software or something that's disruptible. But what's going to happen, and what does generally happen, is if you take $1 trillion or $1.5 trillion, which has been sold. I mean, that's, if you add up what's been sold, it's about at that level. You can't just throw that money into, let's say,
Coke and Pepsi?
Yeah, or the small cap index. It would be double the small cap index of all the stocks. So at some point, you're going to have a basing out, and it could be a month from now, and people will come back into these stocks, and Amazon may give us some good news and say, we're actually, going to curb that enthusiasm and spend a little bit less, because, capital spending on and on and on is never a good sign for stocks.
The partnership with Anthropic is going to become important too, though, in the second half. So there's a race between OpenAI and Anthropic to come public, and I assume they both will. And that's going to be meaningful for Amazon.
Just come back at that comment you finished on. Capital spending is never good for stocks. Now I know people like to say, well, this time is it different? This time, these companies would tell you that this spending is justified and it's going to lead to higher free cash flow than lower. Lower initially, but the benefits are going to pay off, Malcolm, down the road. That's for the most part the argument that Jensen made with us out in California amidst all this consternation about what the spend is.
So I think that was true. That was the narrative we were willing to accept and buy for the last 3 years and suspend our disbelief and buy into it and really love it. And I think what's happening now is the market is starting to pay attention to the fact that at some point you went from asset light to now asset heavy with all of these data centers.
I'm going to see too if we can grab that soundbite too, guys. Can you work on that? See if we can. The other day.
Whether it appears on your balance sheet or not, you now own the debt, right? So Meta with its creative financing and special letter ruling from the SEC and everything else, you own that debt for that data center. So now you're capital intensive on the CapEx side. Now you own these heavy assets that need depreciation at some point on that balance sheet. And I think that's what investors are trying to get ahead of right now. Michael Burry raised concern over the depreciation of the chips and the data centers themselves. And we kind of waved it off a few months ago. I think it's coming back to a head now. It's not just an Amazon problem, it's all of the hyperscalers that are having to answer for. You're now raising debt where we were all excited that you were doing this with free cash flow. So now Google issues a 100-year bond and we're not supposed to get at least a little bit shaken that the idea that throwing $100 billion into the ground in 1 year is not going to come back to haunt us. And I think that's more what we're seeing. The narrative has shifted.
Yeah. No, the debt financing is absolutely a major story. And I think to Malcolm and Josh's point, it's like, when is that ROI coming, right? So when you're talking about hundreds of billions of dollars being spent, again, the plan for this year at the end of 2025 is a $500 billion CapEx number from the hyperscalers. We'll be well north of that already, right? There's no doubt about that. 650 or so. This is a major differential from what was planned. So then it becomes the AWS reacceleration story is just quieted. No one really cares because we're talking about doubling on the CapEx numbers and where does that go? And then the debt financing story. So I think it's shoot now, ask questions later, the old adage that we always hear about. Yeah. And that's why folks are investing in kind of the picks and shovels of this business.
This was, I want to play what I asked Jensen Huang about. All these fears about the spending that led into the time that we sat down on Friday. What he makes of it, whether it is justified or not. Here's what he said.
It is appropriate and sustainable. And the reason for that is because all of these companies' cash flows are going to start rising. You know, people are comparing it to cash flows. One of those numbers are wrong. It's just the cash flow is wrong. Every single company is sees the same inflection point, and that's why everybody's leaning in so hard.
I think there's a misunderstanding about how defensive some of this CapEx is. And I'm not an expert on where every dollar goes. I couldn't itemize it for you. But I would guess this is existential to these platforms. They can't afford to pull back, not have the capacity needed, and then a corporate customer says, well, we were standardizing on AWS, but actually Google is advancing much more quickly, and let's do some trial workloads there, see how that goes. None of these companies can afford to be the one that can't meet the demand. Mm-hmm. The demand is obviously there. The other interesting thing is, historically, when we talk about CapEx, we picture in our mind an ROI that looks something like higher unit sales, right? Like, oh, they're shipping more of whatever because they put in the CapEx 2 years ago. And this is subscription revenue we're talking about. It materializes in a very different way where, yes, there's an ROI, but the way in which it comes in, it's not an immediate revenue like all at once. It's like, okay, user base is growing. Subscription revenue to that user base is growing. And I think that they're all playing defense as well as offense.
But, you know, we do know that Google said they have the same number of headcount as they did 3 years ago and $120 billion more of revenue.
So productivity has gone up, right?
So
revenue per full-time employee has
that's
gone
the
up.
silver lining of this
game.
event.
So
that's what you're, you know, that's
so we have Jensen Huang saying, hey, this is sustainable, justified. You just trimmed NVIDIA. Why?
More risk management than anything else. NVIDIA, for the last, I can't remember the exact date you just had on the board, but I think it was Monday it tracks back to. The last few days, it's been trading right back up close to its all-time high of about 202. And to me, this looks like a good place to be doing some risk management and taking some profits, because at some point, the GPU and the TPU become indistinguishable from each other as far as their capabilities. At some point, that's really good for Broadcom. It's really good for Google. It's not as good for NVIDIA. And so to me, it's not a matter of I don't like the company anymore. I think they'll find the next wave of innovation and get there too. But it looks like a great place to be taking some profits and just spreading those dollars across other opportunities among this SaaS apocalypse that's happening right now, creating much better looking opportunities.
SaaS apocalypse. It has been. It really has been that. Which plays into another move of yours, which I'm going to sort of leave as a cliffhanger for a moment. I thought there was an interesting note. If you think about what's happened with software, we'll just show you the IGV, which tracks it, obviously. And it's so many of these stocks have gotten hammered. Now, some are responding this week in a bounce back, but the longer trend has been ugly, to say the least. How about, there's a note today that says it would probably be helpful if software execs bought some of their own stock as a show of good faith in the business model. However, there has not been, according to this source, a single executive level insider open market purchase of software stocks in the past 2 weeks. Not one. That's interesting.
Yeah, and I think that speaks to I think that speaks to the amount of SBC there is in this sector, perhaps more so than any other sector of the economy. The executives own stock in these companies for pennies per share. It's very hard to get them to see an opportunity has been created. Stock price falls from $350 a share to $310. Yes, percentage-wise, it's a decent-sized sell-off, but they own the stock for 40 cents. So you're probably only going to see token buys, if you see any. And I would just point out, let's not act like software stocks haven't been market leaders for 15 years. They have outpaced almost any other sector you could think of. And throughout the entirety of that rally, and we're talking about compounding at 25% a year for 15 years, nobody's been buying. So I don't know that that's a necessary ingredient, but I would agree with that note, because if you're a retail shareholder, and you don't understand these things, seeing these guys continue to sell on their plans that are planned in advance, can we at least put a freeze on some of the pre-programmed selling? Even if we're not buying, can we stop selling? That's a little insane.
Well, we do have a little bit of buying, at least here in our own little orbit. You bought more ServiceNow, Malcolm. So that stock year to date's down 34%. Week to date, while others have bounced, it has not. It has not.
Yeah.
So why are you buying more now?
So I'm glad that I stayed disciplined on this one and have been averaging my way into it. I've been catching the falling knife, as we all say. So I started buying. I called it peak pessimism on this name when it fell all the way to 150. Then it fell to 125, I bought some more. Now it's fallen to 100 basically, and I just bought again. And I think that what's being missed right here, most software companies tend to be unprofitable, and we tend to value them based on just a multiple of their revenues, multiple of their sales. In this case, ServiceNow actually has growing revenues, 20 being extremely discounted. And so I'm buying it on the premise that all of the good that's baked in there, all the moves into AI, the acquisitions they've made, everything else will eventually start to show itself as value creation and not so much taken away as the street seems to be discounting.
We've also been telling you every day about the roll-on effect of the pullback in software hitting different areas than just pure play software. It's private credit. They've been hit over the last month. There now has been the brokers over the last few days. Altruist, right? They came out with a new tool, and next thing you know, you've got all these financial services stocks, LPL, Ameriprise, Charles Schwab, Raymond James, and Stifel, and others getting hit pretty hard. We bring it up yet again today because, Josh Brown, you know these guys well, so much so that you have partnered with them on various parts of your businesses.
Yes, I'm a shareholder in Altruist, full disclosure, and I'm an advisor to when our clients send us money, that's where their money is held at the custodian, and then the custodian often provides technology tools. And what Altruist announced is pretty amazing. It's a feature of their in-house AI, which is called Hazel, that goes into tax mode. And literally, my advisors and the CFPs who work at my firm can feed our clients tax-related information into this ecosystem that, of course, is very heavily protected, and get insights directly from Hazel telling us exactly what their situation is. And if you don't know much about tax work, I can just tell you they are saving people like weeks and months worth of time when they're dealing with high net worth families, business owners. So it spooked LPL, it spooked Schwab, it spooked Raymond James. Maybe it's not completely unfounded. I do think that those reactions were overreactions, because we will see this type of technology available in many places. Altruist just happens to be a pioneer, and they're very early. Those moves are overdone, but the importance of what they launched and what other firms are launching, AI tools for advisors, should not be overlooked. They absolutely are going to change the economics of the wealth management industry.
So can I go out on a bit of a limb and say it is overblown? So when we see the sell-off that's happening in the insurance companies because of a piece of Claude code, when we see the sell-off in the real estate servicers now, Jones Lang LaSalle's down like 12% today because of a Claude tool. Like all of these different companies selling off 10+% because a piece of code suddenly when is it going to be adopted by the companies? With Claude's co-work, it's got to be able to take over your entire machine and log in as you with your credentials.
Do you think
How long before you're willing to allow that in your company?
Do you think the sellers, I don't know the answer to this. Nobody will admit that they're selling. Is the first. I got calls all over Wall Street. I talked to asset managers. Nobody's like, yeah, I'm selling. But somebody is.
Everybody.
What do you guys think the sellers are thinking? Are they thinking this is real disruption? These companies are screwed. I got to get out now. Or are they playing chess and saying, it doesn't matter if I think this is overblown? I can't have a stock down 20% in the next month because enough other people think. I think it's the latter, where people are just like, well, everyone else is scared, so let me sell first. But I'd love to hear what you guys think.
By the way, don't even look at a stock like Microsoft. I don't think we focus on it enough individually in the residual impact of Anthropic and the things that they've come out with recently, Claude for Work, et cetera. Microsoft is down, look at it over a month.
Yeah, they're worried about Copilot, they're worried about Excel, they're worried about
30%.
What do you guys think the sellers are thinking?
The sellers think that they want to get out before the next seller shows up.
So they don't believe it's disruption. They don't believe it's disruption.
Well, they think it might. Sure, it's going to be disruptive, but all of these companies having their business vanish.
There's been a narrative out there for over a year comparing this moment, the circular deals and everything else, to that of 2000. So everyone's been on edge saying, as soon as something looks sketchy, I gotta sell, and I think this is that moment.
All right, so let's squeeze in a break. So outside the U.S. trade beat the pants off inside the U.S. Last year. We're going to talk about that coming up, while more firms, big ones too, are dumping and pivoting the U.S. for other places. We will discuss. There are a few more to tell you about today and what it all means to your money next. right, welcome back. Let's talk about the so-called sell U.S. trade. Maybe you say it's getting louder in certain areas. Just as a reminder, as I mentioned going to break, last year the outside the U.S. trade trounced the inside the U.S. trade by the widest margin in a long period of time. Give you an idea. The Israel ETF, up 43%. S&P was up 16.5%. Brazil, 41%. Emerging markets, 31%. Japan, 26%. And the FTSE in London, up 21%. So that gives you at least an idea. Then we heard a week ago or so that BlackRock's Rick Rieder was dumping U.S. credit in favor of emerging markets. Now we learn from the Financial Times that PIMCO is pivoting away from U.S. assets as well, according to the firm's CIO, which told the FT that because of the president's quote-unquote unpredictable policies, it was leading to a multi-year diversification away from U.S. assets. Just last week, Amundi, which is Europe's largest asset manager, said it would cut U.S. dollar assets over the coming year and expects the dollar to weaken further. Earlier this week, you might remember that headline for the Wall Street Journal. Wall Street's hunt for cheaper stocks goes global. Last spring, it was sell America. Now it's just buy everywhere else. Not saying that America's done, not sell America, buy everything else. Buy America, but buy everywhere else too. What do you think of this?
I think it's real. I think it has legs. Don't think it's a one-hit wonder as some emerging market and international stock rallies have been over the last 15 years. We build portfolios. We build them with international stocks as a permanent part of the mix. In many years, that means you have to say you're sorry. In some years, that means not having to say you're sorry. But it's an important thing to do because the U.S. equity market has been so strong that the rest of the world has looked at it and said, what are we doing wrong? And they are fixing not all of their problems, but many. Larry Fink's letter to BlackRock shareholders last year was about why did the U.S. recover from the pandemic so much better than everyone else? The depth and breadth and sophistication of our capital markets. Sure. The stock market and the bond market led the economic recovery. The other countries didn't just read that and say, oh, well. Look at what Japan did, the Nikkei. They forced the companies that are listed on that exchange to come up with a plan in writing how they're going to make their shareholders money. We're going to buy back stock. We're going to get this stock above its book value. And you look around the world, all of these different markets working, all of them have put through market reforms to build their capital market strength. And the result of that is people are interested in owning those equities, not just U.S. investors going overseas with a Vanguard ETF. Local, in-country, institutional investors, instead of sending 80% of their money to the S&P, are now holding some back and investing in their own companies.
Also, we know that Kevin Warsh and Donald Trump have talked about this multiple times. One expects there to be several interest rate cuts in the U.S. That's not necessarily true overseas, so that's one reason. And on Rick Rieder, maybe he wasn't happy that he didn't get the job, so he dumped a lot.
No, this was before. This was way before that.
The U.S. dollar is down 9%.
Seriously, this is way before that.
Which is a very big factor here too.
I have an idea for you because we're on this international trade very heavily within my firm. The IDV, the iShares International Select Dividend Fund, is that old economy you guys were talking about. It's energy, it's materials, it's utilities, and that is what's growing internationally right now as everyone else tries to build the infrastructure to support the AI trade. So worth giving it a look.
All right, let's get the headlines now with Pippa Stevens. Hi, Pippa.
Hey, Scott. 4 Democratic-led states are suing the Trump administration to block it from cutting off roughly $600 million in public health grants. California, Colorado, Illinois, and Minnesota argue the cuts are in response to their opposition to the administration's immigration crackdown. Some of the grants could be terminated as early as today. A Health and Human Services spokesperson said in a statement to Reuters, the grants do not reflect the agency's priorities. The U.S. reportedly smuggled around 6,000 Starlink terminals to Iran amid the country's deadly crackdown on anti-government protesters last month. It came as the regime carried out Iran's longest ever internet blackout. The Wall Street Journal reports President Trump was aware of the deliveries, but the White House has not commented on the report. And the Kremlin said today Russia has blocked the Meta-owned WhatsApp for failing to comply with local law. Officials in Moscow suggested Russians use the state-owned messenger Max instead. Critics say Max is likely a surveillance tool. Scott, back to you.
All right, Pippa, thank you. Pippa Stevens coming up. Josh Brown's best stocks in the market. We're talking housing today, and there's only one builder that made the list. We reveal that next.
As our country celebrates its 250th anniversary, CNBC spotlights the leaders driving business and the nation forward.
To me, the magic of the United States is it's a country of immigrants that has brought the best and the brightest. It's created an environment of freedom. Freedom to do well for oneself, freedom to make choices, freedom to have entrepreneurship. And it's an environment of equal opportunity, as long as you keep it an equal opportunity. And that entrepreneurship and that market environment so that people could build wealth and educate their family well. These are the essential ingredients that have made the United States unique, and I hope that we keep them.
All right, we're back. Josh Brown's best stocks in the market.
This is my favorite part of the show.
Well,
Can you imagine that?
The tease said that you have a spotlight on housing, but only shining on one name, and that is PHM, which is
Pulte Homes.
Pulte Homes.
Look, we have other residential construction constituents on the list, but the only home builder, PHM, right now. I think this is the bleeding edge of what's about to happen with these housing stocks as the Trump, the Warsh Fed takes its position. They don't even need to do a million rate cuts. They can just give the market the impression they're leaning that way, and that'll be the trigger. This chart that you're looking at here, number one, the yellow line is 200-day moving average. Very simple. Two tests of that level. It barely kissed that level twice. Look how quickly the buyers came in. That is exactly what you want to see. Guys, give me like a 5-year if you don't mind. I want to show you a cup and handle for the ages. This is one of the most bullish patterns that you will find. There it is. You see that cup? Then you see the handle forming. Now you see the stock about to take out that top line. I think above 140, next resistance 150, and then there is no resistance. This is the best of the home builders right now. Your stop, your risk management here is fairly simple. 200-day moving average about 119. I think if you see this stock break 120, especially with high volume or violence, that's your signal that the trade's not going to work. Fairly small risk to take given the potential upside. I like Pulte here. I think it's going to work.
Okay. What about this gentleman, Jason?
I like DHI. You know, affordability obviously is a major theme. You know, just as Josh said, the jawboning from the Fed is going to be important from Wars directionally, at least if we can believe that rates are heading lower. Names like D.R. Horton, who, by the way, is already up 15%, close to 15% year to date, and almost 30% over the last year, will work. And I think that's going to be the opportunity. Of course, the 10-year, the steadiness there, we kind of need to see that come down for mortgage rates to come down.
Worth pointing out, none of the home builders are disruptible by Claude. At least
you got it.
At least
1,000%.
not yet. It fits into the paradigm of what's working this year.
We just can't really get anything going, though, for the most part, in anything related very much to housing, can we?
It's all about the 10-year.
Well, I mean,
builders
okay,
doing well.
That's fine, but in general,
stocks are up year to date, Judge. I mean, I got to be honest with you.
Not
got to push
early,
back.
Not Rocket. I mean, I own that one, RKT. It owns the entire process of the home buying experience, and until the 10-year does something positive, like nothing in that.
I guess that's what I was focusing on, more of that side of the market. Well, the market's been a disaster for so long. If you look at what the performance of the home builders last year for a calendar year, whatever the home builder ETF is, if you look at it for 25, I guess that's what I'm going
It's
more of the
affordability.
longer term trend.
People aren't moving because they've got their low price mortgages. The people who are buying can't afford the house. So.
Well, the home builders ran out of firepower too, right? They were paying people to buy houses last year, and that just doesn't work in 2026. I think that's
fits and starts with the movement of rates. All right,
These stocks are, I mean, just look, can we please? We're going to break the September high. It's a break. I mean, it's. I understand the narrative isn't great, but like the stocks are working and they're breaking out right now.
Well, that's why we have a segment called Josh Brown's Best Stocks in the Market, because ideally what has been dark for a while is being now lit up.
That's right. You're welcome, America.
All right, Santoli's next. back with our senior markets commentator and overtime co-anchor Mike Santoli for his midday word. Midday here, I guess my word's kind of ugly. What's yours?
It is ugly, and obviously it's reached kind of the surface of the market. I mean, I feel like I need to tap the sign again that says a broader market is not a safer or more rewarding market. It's been very broad. It's been 4 months of this when you've had the average stock, most stocks going up every day, the advanced decline line making new highs. It should mean the S&P eventually does, and maybe not, too long from now. But I do think that just the treacherous action below the surface, this hunt for the next potential perceived disrupted area, I think it just saps conviction in general. Too much internal volatility for the broader market to sidestep it for long. I mentioned in the 9 o'clock hour that the difference between the average 10%, the average move in the individual S&P 500 stocks and the index itself is in the 99th percentile of the past month. So sometimes that's an inflection point for the overall market, or it just means that some of this excitable action is just going to cause people to reduce risk. So I think that's what we're seeing right now. It doesn't really break any ranges or upend any fundamental stories, frankly, but it definitely it makes people move their feet a little bit.
VIX over 20.
Yeah.
Transports down almost 6%. What goes up a lot comes down a lot.
In that instance, for sure. So I do think that, part of this is the market exposing where people were kind of just mechanically rotating into areas that seemed like they were going to be, free of any of these AI fears. Transports, for sure. The run at hot economy trade definitely gets crowded coming into this year. Frankly, the market in general softened up after the existing home sales number. That's when yields cracked and you saw a lot of the cyclicals move lower. I'm not sure if you could say that should happen, but that is the way it went. So I just think it's a matter of, you have this one, rock thrown into the pond and the ripples start to go from there.
All right, I'll see you at 3. Thanks, Mike. That's Mike Santoli. We'll see him on Closing Bell. We'll do the setup after this. let's do the setup. Some earnings that are front and center. Applied Materials after the bell today. Carrie Firestone, you are in that name. The SMH, by the way, I think hit another record high.
Yeah, exactly. Well, if it's not chips, it better be chips. And this stock we bought last year, mid-year, it's doubled since then, and we think it continue to go higher. I don't think that there's any surprise that the earnings are not going to be great. They've signaled that they expect this fiscal year to be relatively flat. Next year, fiscal 27, will be up about 30%, but the business is very strong. I mean, they're at capacity, and all of these chip manufacturers need their equipment. So that's what's driving this, just as it is the other names in the sector.
Okay. Toast, they're after the bell too. That stock's getting creamed today, down almost 8%.
Every day.
It's down 23.5% year to date.
Give me like a 30-day chart. I think it went down every day except for one.
Why?
Because nobody cares. So they have 150,000 restaurant locations, including working with some of the biggest enterprise-size customers like Marriott in the country. I would guess roughly out of that 150,000 restaurant population, approximately 0% will abandon their payment software for something somebody vibe coded in the back of the kitchen on their phone. However, the market does not care. Do not want to be in this name heading into the earnings. I totally understand it. It's a falling knife. I've already caught it twice on the way down. Every average down looks dumber than the one before. But let me just give you the numbers for fun, okay? They grew, last quarter, they grew 25% year over year. There was AI then too. Somehow they managed to squeak that out. They are going to do $1.62 billion in revenue this quarter, which would be a 21% growth rate year over year. And analysts are looking for 24 cents a share. A year ago, same quarter, they did 16. If you think that's a sell it. I'm not going to tell you not to. I have no idea when this stops. I'm only going to tell you, out of every group of people who might replace their software with AI, this is probably the least likely. And oh, by the way, they're doing tons of AI stuff to bring to the restaurant owner customers. So you tell me when people are going to pay attention and actually care about the fundamentals. I have no idea. I couldn't even guess.
All right. We'll take a break. We'll come back and we'll do the finals next. All right, with the market getting hit pretty good, Dow's down almost 650. You probably want to hear from one of this nation's top financial advisors. We have one. Richard Saperstein joins me 3 o'clock. He'll be right here on set with me, so perfect timing for that. Adam Parker, Brian Levitt, Stephanie Guild as well, and I hope you'll join me then. Let's do some final trades. Jason Snipe, you first.
I like AXP here, selling off with a lot of the financials. That credit card cap was a little bit of a story, but they've been focusing on the millennials and Gen Z. I think that would be accretive in the long term.
Mal.
Spotify, prices up, subscriber growth up. I like it.
Okay. Care.
Lindy, it's an industrial gas company from Europe, not American, no disruption.
She got the memo about the green stock on the final trade.
She did. I'm violating my own rule and pointing out Devon still in its uptrend, pulling back with the energy sector. I like it.
All right, good stuff. I'll see you at 3.
Thank you very much, Scott. New AI victims, new margin concerns, and a big miss on the housing front. Welcome to The Exchange. I'm Kelly Evans, and we have a sell-off on our hands this afternoon. Take a look across the major averages, and you see declines of more than 1.5%. That has the NASDAQ down 424 points. The Dow is down, hate to say it, 666 at this hour. And the 10-year yield, well, that has sunk to about 4.12% right now. Fears over AI disruption are claiming some new parts of the market today, like trucking, with the C.H. Robinson on track for its worst day in more than 2 years. It's down 22% today. Expeditors, RXO also selling off, and in commercial real estate, CBRE, as you can see there, it's down 15%. Newmark is down as well. That's 10% today. And now back-to-back drops of about 20% for a couple of names here under pressure. We'll circle back to that in a moment. But let's begin with kind of the flip side of this whole trade. As bad as it's been for software, it's been great for hardware. Anything that goes into making AI, and memory specifically. These winners now even starting to take a bite out of Cisco on margin pressure today. That has Cisco shares under pressure. But SanDisk, Western Digital, and Seagate, they're all higher, bringing their one-month gains to more than 40% as prices for their memory components soar. While they're winning, the names reliant on those components are feeling the squeeze. That's sending Dell, HP, HPE, and NetApp down as well today. Many of these companies have already reported that pressure. Who will be able to navigate it the best? Let's bring back Mehdi Hassani. He's a senior analyst at Susquehanna. Mehdi, you told us right here a couple weeks, might have been a month ago now, just how good, I guess we could say, things are for the memory makers. Well, now we're seeing the flip side of that. Welcome.
Right, thank you. Thanks for having me on the program. I think what you're seeing and reflected in Cisco's results is inability of these OEM to pass on the extra cost to the end customer. We have been under impression that maybe 60 to 70% of the incremental costs could be passed on. But there are two factors here. The memory price increase has been more than expected, and OEM's ability to pass on the extra costs is more limited than what we thought it would be in the past.
Really? So some might say, okay, like take an Apple. And you and I discussed this as well. You know,
right.
Is Apple going to raise handset prices 15% because of the memory chip? Maybe. I mean, that's what some analysts are out there saying. They also have huge pricing power. What about Cisco? I mean, not that you're an analyst on those names, but my point is, should we expect everybody that uses memory chips because of the squeeze across the board to face these pressures? Or do you think they'll fall harder on some areas, maybe be a little easier for those who have massive heft in the market?
I actually think the margin squeeze will be more severe for the likes of Dell, NetApp, Pure Storage, HPE. On a relative basis, memory costs for a smaller portion of the bill of material for Cisco. As you look into Dell, HPE, NetApp, the memory cost mix is actually much higher. I think for companies like Apple or Dell that have a large volume, they could always tap into suppliers from China for the systems that are shipped to outside the US. This is kind of a gray area. We still don't know to what extent these big OEMs could procure from China for shipment outside of China, but it's US. But others, like NetApp, HPE, they have more of an exposure to the US, and to that extent, their margin pressure could be intensified.
Yeah, and you do cover those names. I mean, you have a hold pretty much across the board, as far as I can tell. Although I don't see Cisco in the coverage space here. So, how long does this persist, Mehdi? I mean, we know and we've heard that it could take years. You know, when we talked to the CEO of Western Digital a couple of weeks ago, he said, "Look, we're booked out for a couple of years at this point. We're talking 2028." So, should investors move to the sidelines on those who are receiving, you know, memory chips? Is there any? What's the next layer of this trade?
So you asked me two questions. How long is it going to last? We don't know. Number two, would investors be better off moving to the sideline? I think so. Look, we were on the program a month ago, and this memory price increase has been known. Yes, maybe it's a lot more severe than in the past, but these OEMs have had plenty of time to prepare. They also don't know to what extent this is going to last. What you and your listeners need to know, it takes several years to add incremental capacity. So this could potentially last into 27. And this is where the margin pressure could actually intensify into mid or latter part of a 26.
Is this going to be another inflationary? You know, we always think about technology as being pretty deflationary over time. This looks like an area where we could see some inflation pressures. And I don't know if that's anything that the consumer feels that much, although again, the sticking laptop prices, maybe, I don't know if handset prices, TVs, I mean, just the cost of kind of data usage, certainly for the enterprise, how much do you think they might try to pass along? Like, if we're talking about 15% price hikes, is that about in the realm of how much more expensive? Because the memory prices themselves, you saw those first quarter numbers, they were saying they were going to raise prices 60 or 70%.
Yeah. I think the short answer is I don't know. Anything to do with consumer is more of a black box. Apple does have non-hardware revenue, which carries a higher margin. To what extent can Apple scale that? Outside of Apple, it's a black box. I think enterprises, to a large extent, would be able to absorb some of that cost increase compared to consumers. Dell, that has some exposure to consumer notebook, could feel it more on the consumer side. On the enterprise, could relatively be easier to pass on. But we're in an environment where there are many questions with limited answer. But going back to your original question, what should investors do? I think investors should be very cautious. The unit volume or higher revenue is not going to offset margin pressure, and this could be sustainable for more than 1 or 2 quarters.
And there's shares of Apple, which are actually having one of their worst sessions in some time, Mehdi, now down about 4.5%. Again, not a name that you can speak to per se, unless you'd have any final comment on that.
I think we actually do a lot of supply chain as it relates to Apple. I think there are some cool features coming out with iPhone 18. Could consumers pay a little bit more? I don't know, but I think this is a question to be put into the service providers. Could Verizon, T-Mobile, those guys be able to absorb some of the higher costs, because they're right now subsidizing, and this is something that's beyond my focus. But at the end of the day, I think going back to my coverage universe, the Dell, HP, NetApp, they don't have a whole lot of non-hardware revenue. And they should probably feel more margin pressure than Apple, that could probably try to scale their services business and find a way to work with the service providers for higher subsidies.
Yeah, it kind of made me an anecdote that captured it all. My husband broke his iPad. It just used it's old, right? And he asked Gemini if he should replace it. They said, "No, wait for one with better features." And I said, "Well, but if prices are going up, you should buy it now." So if that conversation between the iPad, the memory shortage, and Gemini is all happening in one household, I can only imagine the ripple effects that this will have really in the months to come. Mehdi, thanks as always for dissecting it for us.
Okay.
Mehdi Hosseini joining us there. Let's turn to the broader markets now, as stocks are picking up some steam in the sell-off. As software names continue to decline, another group of stocks has taken over as the leaders in tech, and that's all the old economy. Rails, industrials, energy, staples, that's where we're seeing the broad market leadership, while software, crypto, hyperscalers, they're all lagging. Will this trend continue, and what should you do about it? Let's bring in Chris Grisanti. He's the Chief Market Strategist at MAI Capital Management. Chris, it's great to see you. I'm curious which way you're leaning. Is it, with the rise of the old economy, especially in tech, I know you've had some sympathies there, or now that we're seeing the sell-off to such an extent, is it the time to look at a Workday, a Salesforce, a ServiceNow?
Sure. Well, Kelly, first of all, it's always great to be back with you. I'd say it's a great time to be a value investor. Finally, I've been talking about the old economy stocks on your show for several years now, and finally they've come into their own. But as a value investor, all of a sudden, while these guys are doing great, it's time to look at the stocks that are down so much. And for us, it's much easier to look at the folks that are going to benefit from AI than to try to pick a falling knife of the ones that may or may not be disrupted. I think that's just too hard a question to answer.
Yeah, the too hard pile that Munger is famous for is the Dow is now down 637 points. All right, so where you always have kind of specific names you're looking at. What are they right now?
Well, this isn't like rocket science, but it's a shocking thing for a value guy to say. We absolutely love NVIDIA and Microsoft. And the reason is both are selling at 10-year low valuations on next year's forward earnings. And the question everyone's asking is, will this huge AI spend be worth it? But I think that's the wrong question. I think the question for investors for 2026 is that money going to be spent? Because if it's going to be spent, and I think it will be, then a lot of it's going to go to NVIDIA, and Microsoft, which is capacity constrained, will start to see growing revenues, growing earnings, and they're both selling below a market multiple. So that's what us value guys love. We love to see bargains plus earnings growth. We don't usually get that.
I love when we bring on a guest who says my two big value ideas are NVIDIA and Microsoft.
Right. The stars are lining up.
So that's pretty remarkable. There's plenty of people who are pointing to these valuations and saying, we haven't seen these names at these entry points in effectively years. How do we know, Chris, that the moment is not past us? And
sure. Well, you got to put things into three categories. One is the things that may or may not be disrupted, and that's just too scary certainly for us value guys. So you're looking at Adobe and things like that. So in that group, you try to find the ones that have some proprietary nature. Like I think ICE, Intercontinental Exchange, they have proprietary stuff, so I don't understand why they're down so much. As opposed to Booking, which is an aggregator, which is a great aggregator, but AI, that's what AI does for a living. It aggregates things. So I would be much more worried to own Booking than I would for Intercontinental Exchange. Then you get to the folks that win with AI, and there's nobody that wins more than NVIDIA. So if the AI spending shocked everyone, and clearly it did, then NVIDIA's earnings, just connect the dots, there are not very many of them. NVIDIA's earnings have to be much better than we thought they were going to be 3 months ago, and yet the company's at a market multiple. So that's what's exciting.
What's not exciting to you? Where would you, as you mentioned, you're not necessarily ready to kind of pick through the rubble in the sell-off because it would take a specialist maybe in the software space or but when CHR, are these gifts on some level to wake up and see a stock that has earnings and it has revenues and it has, a moat and it has, is that moat going away or is this a gift when stocks are down 20% because there's just people casting around for the next possible victim many years from now?
There's clearly baby getting thrown out with the bathwater here, Kelly. But I think the best thing to do, because so many stocks are down, is stick with what you know the best. So I'm not comfortable with trucking stocks, so I'm not going to go there. But I am comfortable with hyperscalers. I'm comfortable with value-added data sources like S&P Global, like ICE, and I'm confident that that's a baby with the bathwater example because they have proprietary data and they'll use AI to offer their clients a better way to get at only the data that they possess. AI won't get their hands on their data. So that's that's where we're spending our research time, and we're like kids in a candy shop because all of a sudden we've got value and earnings growth, and that's something a value investor doesn't get all that often.
All right, Chris, if you just stay there for a moment, Rick Santelli is standing by patiently, but with the results of something very important, which is the 10-year auction that we've been watching all week long, Rick. Didn't go so well for the 10-year yesterday. What about today, the 30, right?
30-year, $25 billion, and it was a spectacular auction in terms of demand. $25 billion, as I said, the yield, 4.75, which is 2 basis points lower than the when issued market. Lower yield, higher price, government was the seller. It priced aggressively. It doesn't end there. The bid to cover 10 auction average is 2.36, meaning 2.36 times as many bids as there is securities available. This auction went off at 2.66. That's the best bid to cover since 2018. It still doesn't end there, okay? It's like the buffet table. The primary dealers get all the leftovers of whatever the customers didn't buy. Well, they only got 5.9%. I have 20 years of data on 30-year bonds. I couldn't find a smaller percentage. So that is a solid number. No matter how you slice it, the difference between yesterday and today is significant. And what does it mean? It means two things, and I'm not sure I agree with them, but here's what I think it means. They're doubting yesterday's strength in the labor market, and they're confident tomorrow's CPI for January is not going to come in hotter than expected.
Good point, because that would certainly change the narrative. Rick, thank you. Chris Grisanti, let me just circle it back to you for a quick final take here. Maybe falling bond yields will help this market ultimately find its footing, but would you broadly describe what you're seeing as panic over a new innovator on the scene? Is there an economic element to it? What do you think is going on here?
Yeah, it's not so great getting older, Kelly, but sometimes it is in the sense that I remember the late 90s, and I remember the disruption of the internet with the stocks that we were managing. And they'd go through these convulsions, every 6 months or so. And they turned out to be opportunities until, of course, the peak in 99. I don't see the peak. I don't see the valuations. Believe me, Microsoft was not selling at a market multiple at the peak in 1999. So I think we have panic, and I think that spells opportunity for careful investors.
All right, Chris, we'll leave it with those sage words. Thank you for joining us. Good to see you this afternoon.
You too, Kelly.
Chris Grisanti with MAI. Speaking of this new economy, our next guest is fueling the transition from copper to fiber optics. We'll speak with the CEO of TTM Technologies, with the stock up 30% year to date. Plus, the worst drop in home sales in 4 years. And could that be why the market is in such a foul mood today? We'll get power player Ryan Serhan's take on that and why he says the bottom half is seeing real distress. We're back after this.
This is The Exchange on CNBC.
Welcome back. Shares of TTM Technologies are up 31% this year as they continue to see huge demand from data centers. They make printed circuit boards and could potentially be one of the big winners in Google's $185 billion AI infrastructure push. Joining us now is Edwin Rox. He's the president and CEO of TTM. Edwin, it's great to have you here. Have you ever seen anything like this?
Thanks for having me, Kelly. And no, I've not seen anything like this. This is really an inflection point also for us. You know, about 30% of our business is in data centers and networking, and that's basically riding the wave at the moment. So while these data center customers invest, let's say, hundreds of billions, there is a lot going in hardware, and this is exactly what we supply. We supply the connectivity to basically interconnect all these sophisticated chips in a very efficient way. So I'm very happy with this.
Are you so let's go back over the timeline, and now there's this scramble for all of the physical stuff that goes into quickly putting together these data centers, and we're seeing shortages as a result. We were talking about the shortage of memory. Would you say that your supplies are in shortish supply, or are they scarce at all? Are they plentiful? How quickly can you meet demand?
No, exactly. Basically, what we guided the street is about 15 to 20% over the coming 3 years, and that demand is there, that supply is there. We don't see any issue at the moment from our suppliers, and we have our capital investments, let's say, around the globe to be able to supply this. So we are able to support this growth as well as the innovation, by the way, going, let's say, from copper to optical.
Yeah, and you yourself have a long pedigree in kind of tech, defense. This area your company has been through so many different cycles. How quickly are you able to identify when something like ChatGPT or now the whole AI wave is coming? I mean, did you notice right away, going all the way back to 2022? Is it picking up steam now that we see, when I'm looking at what you can do with the software coding now, right? Like, how does that translate into what you're experiencing on the back end?
Now, first of all these investments, let's say, of these big data centers are mostly still in hardware. So 75% of the budget is used for hardware, the physical layers, basically. That's energy and basically where we play in. We have very, very strong and very close relations with our customers. We have our roadmaps, let's say, in copper. We have our roadmaps in optical. We are very good in making a lot of layers. So if you make a lot of layers, you get basically very compact systems. So it is mostly, Kelly, it's mostly that alignment with our customers, which makes sure that we are on time, that we invest, and that we are, let's say, a good partner for these customers.
Are you yourself using AI in the company?
Yes, we do. We do a lot of optical inspection. We do a lot of, let's say, inspection of our big circuit boards. And for instance, that's a good example where we use AI. You can inspect them with a human being, but that's not the most efficient way. So we use AI for these type of things. That's just one example.
How labor intensive is both kind of your corporate sort of staff and then also what's happening on the factory side? So as we look at a business that's getting a big boon from what's happening, most of the focus has been on, hey, look at Anthropic, they only have 700 people or whatever the number is. How labor intensive is your business, and what does growth there, is your growth going to lead to more hiring?
Yeah, absolutely. At the moment, we have 18,000 people in the company, mostly in production, of course, around the globe. That means China, Malaysia, US, and soon Europe. So that's happening. But we also have a lot of R&D staff, also, let's say, in different parts of the globe, to make sure we are on time and we are making sure that we have that innovation cycle. As you can be aware, it's going so fast that innovation has to be also very fast. So indeed, R&D is critical. Bringing things very quickly in production is very critical. So again, 18,000 people, and we're growing.
Yeah, that's fascinating. Edwin, thanks for joining us to kind of pull back the curtain a little bit amid the explosion of this technology. We appreciate it.
Okay, thank you very much, Kelly.
Edwin Rox with TTM Technologies. Stock down marginally today, as mentioned. It's up 31% since Jan 1. Coming up, what a difference a week makes. On Friday, C.H. Robinson was at a record high. It's now having its worst day on record and dragging the Dow transports to their worst day since April. Is AI disruption targeting trucking stocks? We'll dig into that. And as we head to break, here's another look at the broad markets, which are under pressure. The Dow had a 300-point gain this morning. It's now down 615. We'll have more of the day's biggest movers when we come back. Welcome back, and we're monitoring this market sell-off. Dow is off the lows, still down 583. Not a great session. And the small caps are actually the worst hit, down more than 2% right now. Quick check on Bitcoin as well gives you maybe a sense of risk or liquidity, or maybe not. Maybe it's just Bitcoin. It is down 3%, though, to just over 65,000. And we have a broad-based sell-off in the metals. Gold, silver, copper, she said, and platinum. Look at silver down almost 10% today. It's a pretty huge move. It's trading back around 76. Now, we mentioned Apple, and the update to Siri has been internally pushed back to May or potentially later, after being expected to launch within a couple of weeks. We showed the shares earlier, thought it was more of a Cisco memory issue, but now we have this word about what's happening with Siri as well, and those shares are down almost 5% to their worst day since April. On the flip side, Fastly is soaring 60% toward their best day on record. This is a cloud platform operator. It beat earnings estimates this morning, gave strong full-year guidance. The stock is back to its highest level in 2 years on an 80% jump today. And check out the transport logistics names, which are seeing some big selling pressure. C.H. Robinson is down 20% today. Worst day on record. And they say it's AI disruption fears rattling the trucking stocks now. Got to turn to Frank Holland for more detail. Frank, on this one, what do you know?
All right, Kelly, so AI disruptions, that could be one factor. But I want to point out it's not just the trucking stocks. Dow Transport's overall on pace for their worst day since April 3rd, following the so-called Liberation Day tariffs and a lot of concern about the economy. However, as you mentioned, trucking and truck brokerage stocks are the hardest hit. C.H. Robinson, Expeditors, J.B. Hunt, and Landstar, they're the biggest laggards in the transports. You also see Knight Swift, the nation's largest trucker, falling With a lot of analysts and investors I'm talking to, the main word I'm hearing from them, irrational, with these transport names that have been outperformers this year potentially being sold by investors trying to cover losses in other areas like software. There's also an analyst note out from Baird saying it may be due to a new AI platform. I'm going to get to that in just a minute. But real case in point about this potentially being irrational. Knight-Swift just announced a double-digit increase to its dividend, a move that generally signals to the market confidence in future operations and cash flows. Also in the transport, C.H. Robinson seen as the poster child for the use of artificial intelligence, again, in transports. We spoke with CEO Dave Bozeman on several occasions about how AI is helping that company reduce headcount and expand its margins. Last quarter, margins expanded by 80 basis points. Now, one other possible factor here is the FedEx Investor Day. The stock at one point up over 1.5%. Now you can see it's in the red. Its revenue forecast for 2029 and some of the other targets, they could be seen as a bit tepid, especially with the logistics giant emphasizing its push into data centers and then also the circular questions about that build out, Kelly.
But no specific cattle. It's not like, you know, they always have a fun name, like it's Harvey for legal. What's the one for financial stocks that wiped out? For trucking, it's not like, you know, Frank came online and now everybody, like, what is the catalyst? Why today?
Well, according to Baird analyst Dan Moore, he just put out a note a short time ago. There's a company called Algorithm that put out an article today saying that they have an AI platform that can help smaller companies scale up to basically compete with larger companies without increasing headcount. That could be one of the factors weighing on this. But again, automation, as that analyst from Baird points out, is nothing new when it comes to transports. And C.H. Robinson really been the poster child for doing that already. That's a big reason for that stock's big climb over the last year. But we are seeing a very deep sell-off. So it seems to be a multi-factor situation.
Algorithm with a Y, you know?
Right.
And look, my hat is off to everyone who's taking this technology seriously. I mean, this is the innovation. This is the new business. But to see these moves in established names is pretty shocking, and we look forward to hearing more and learning more about these new businesses. Frank, thanks so much.
Kelly, thank you.
Frank Holland. Let's get to Pippa now for the CNBC News Update. Pippa?
Hey, Kelly. A federal judge temporarily blocked the attempt by Defense Secretary Pete Hegseth to censure Democratic Senator and retired Navy Captain Mark Kelly over his participation in a video where he urged U.S. service members to refuse illegal orders. The judge ruled Hegseth's actions are likely unconstitutional. Hegseth has been looking to reduce Kelly's rank and cut his retirement benefits. In his ruling, the judge said the Pentagon has trampled on the senator's First Amendment freedoms. Russia launched a series of ballistic missile and drone attacks against Ukraine overnight, further damaging Ukraine's energy infrastructure and knocking out power and heat to thousands. The attacks come as Ukrainian President Volodymyr Zelensky says Moscow is hesitating about another round of U.S.-brokered peace talks. And Switzerland announced it will hold a referendum in June on whether to cap its population at 10 million people until 2050 by limiting immigration. The petition was backed by a far-right political party. Both the government and parliament oppose it, but the referendum was automatically triggered after 100,000 people signed the petition. Kelly?
Wow. Okay. Pippa, thank you very much. Pippa Stevens. Coming up, commercial real estate, they're getting crushed, as we mentioned, the past couple of days, as fears of AI disruption ripple through that sector as well. Our next guest, though, thinks that sell-off is overdone, as sentiment has been overshadowing strong fundamentals. Can they survive the AI transition? We'll get his thoughts and top picks in the space next. AI fears are rippling through commercial real estate today, with names like CBRE Group and Newmark under pressure. Both are down big and over 20% in the past 2 sessions now. But our next guest is saying to buy the dip, that the fears are overblown. Alex Goldfarb is senior research analyst at Piper Sandler. Alex, it's great to have you. First of all, what do you think is the catalyst here for these declines? Does it make sense to you?
It doesn't make sense, but having lived through the COVID sell-off, the dot-com bust and the housing bust and everything else, there's always nervousness whenever things change in the market. Clearly, AI is the focus. You've seen that in the software stocks, you've seen that in insurance brokers, and not surprisingly, it's coming after commercial brokerage and the office stocks. There's a fear that's naturally human of job displacement, but even us on Wall Street, we were supposed to all be shipped overseas or off to, lower cost markets, and yet employment, office using jobs in New York have eclipsed pre-pandemic levels, and space availability in Manhattan is, quickly compressing. So you're talking about physical versus the virtual. We've seen this in retail. The malls were supposed to go away because of the internet. That has not happened at all. In fact, quite the opposite. And the same fear is coming to office.
So just to be clear, you're telling me that the reason commercial real estate names are selling off is because people think that AI is going to lead to mass layoffs, and there's not going to be anyone to sign new office leases and fill these buildings?
It strikes us a lot like what happened with the internet a decade ago, when everyone thought people would skip the mall, skip the shopping center, and just sit on their couch and order product. The pandemic upended that and showed that, in fact, physical retail is where people want to be. The same thing happened at that point with work from home. Everyone thought there'd be no need for office because everyone would sit on the couches and work from the comfort of their home or their apartment. And quite the contrast, as JP Morgan has demonstrated with their new headquarters, people want to be back in the office. You're seeing that in New York, you're seeing that in San Francisco. I mean, San Francisco office recovery is being driven right now by AI companies and people who want to be in the office. But there is a fact that AI is bringing an incredible efficiency, and people are trying to figure that out.
Yeah.
But ultimately, it comes down to collaboration and working in the office to create the very product that people are fearful of.
I thought perhaps there had been a new commercial real estate, platform, leasing platform or something that was AI based, that was going to do, somehow make a better mousetrap. And maybe there is. I mean, this stuff is moving so fast. There could probably 10 of them have launched since Monday. It's even more interesting to me that it might literally be just a seats issue. It reminds me of what's going on with software, where people are worried, oh, there's going to be fewer workers, so there's fewer people to have, pay out for a Salesforce model, fewer people to sit in offices. I mean, it feels a little irrational. I'll agree with you. What would you say are the best buying opportunities in your coverage space right now?
So here at Piper Sandler, I mean, certainly in commercial brokerage, Newmark, if you look at the stock, it's down 2 multiples from Friday. So think about that. The stock is off 20% since Friday. It's down 2 multiples, despite the fact that we're forecasting upper teens earnings heading into 26. The company, under the leadership of Barry Ghostin, has done a phenomenal job of going global, improving their diversity of earning streams, both from corporate users, data centers, leasing transactions. And what's really interesting and people miss is there's an entire wave of real estate transactions that were done back in 2021 at sort of aggressive underwriting and very low cost debt. All of that is coming due, and it needs to either be worked out or transacted. At the same time, you have corporate users, like I mentioned before, trying to figure out how to best get their workforce back to the office in a world where there is no new office buildings going up. So when you look at Newmark, in our view, the story has cleaned up tremendously over the past few years, especially with the departure of Howard Lutnick. And it really, for people who are looking for companies leverage to the economic growth, Newmark is a really good story.
It's fascinating. Like you said, PE is contracting. Clearly all the worst fears that could be realized with a name like this are being realized in the market today. Alex, thanks, Alexander, Alex, if I may. Thank you.
Either way, my wife calls me a variety of names. I'm just happy when she smiles.
Probably depends on the day, Thank you so much for making the time. A really, really brutal day. I mean, this is probably for you, would you say then the worst day since COVID for the space that you cover?
Yeah, I mean, I remember early days of COVID when the market was just going crazy and we just had no idea what was going on until, you start a few days later reading about the virus. For us, AI has been a topic in real estate since last year. The office landlords have been peppered with it repeatedly. And what's really interesting is when you look on the ground, office leasing, if you look at SL Green, Boston Properties, Vornado, their leasing pipelines have only strengthened over the past year, despite the AI. And even with Mayor Mondani into New York leasing was at record levels in the fourth quarter. People are now willing to pay $150, close to $200 in rents, levels they would have never paid before. And that's in contrast to the AI fears that have, grown over the past year. So again, we think there are buying opportunities. Newmark, as I said, it's down 2 multiples from Friday, down 20%, and yet you're looking at a stock with upper teens earnings growth into 26.
All right, Alex, thank you so much for bringing the data, the insight behind what might be going on here. We appreciate it.
My pleasure.
Alex Goldfarb with Piper Sandler. Coming up, all startups are spending big money when it comes to AI. That's not news. The news is where they are spending it. We'll have some of those details next. And as we head to break, 2 retailers on very different footing today. Crocs having its best day in a year on a big earnings beat and smaller than expected revenue loss of 21%. Different story for Birkenstock, which is down 2% on a revenue miss. We're back with more after this. Welcome back. The AI race is getting more political and more divisive. Anthropic announcing today they're donating $20 million to a super PAC that supports more guardrails around the technology. OpenAI is following a different playbook. Deirdre Bosa has more in today's Tech Check. Deirdre?
Hey, Kelly. So put simply, AI's internal civil war over safety is going public. So Anthropic just put $20 million into a super PAC that does push guardrails like kids' safety, chip export controls, and transparency rules. On the other side, you've got a coalition led by OpenAI's Greg Brockman and Andreessen Horowitz. They've poured $125 million into a PAC that wants just one federal standard and no state regulation. So the White House is with them. But the backlash, it's only increasing, and it's coming from inside the building. This week alone, researchers left OpenAI and Anthropic, citing ethical concerns. xAI lost the co-founder who ran safety. And yesterday, a former OpenAI researcher published a New York Times op-ed warning that putting ads in ChatGPT is the Facebook playbook all over again. Now, this isn't just talk, Kelly. OpenAI dismantled the team built to make sure AGI benefits humanity. xAI reorged with no dedicated safety function. And the reason this is so consequential right now is because the models are starting to improve themselves. And this is a line that safety researchers have warned about for years. AI building with AI. ChatGPT's recent model, the people that built it said that it helped write itself. And that's when you start to get to those scary sort of Terminator-type fears that were pushed a few years ago but have seemed to faded away until now.
You know, Alex Bors was on Squawk Box this morning talking about his, the RAISE Act, something like that, his AI, probably RAISE AI, his proposal that would be maybe starting for New York but really would go nationwide. And it has a lot of common sense stuff just about the most serious harms where we've seen this technology being used. I know that the companies are, everyone's concerned. We don't want overbroad regulation that kind of slows down innovation. So I can't tell if this fight between the two companies helps or hinders these efforts, right? They're very different approaches here.
Yeah. It's kind of been on brand for Anthropic, right, to say and raise all these safety concerns, but it helps them because they say, okay, we literally are built with safety in mind. We left OpenAI to build a safer AI ourselves, so that helps them. Whether anything gets done about this, I don't know. The argument always comes back to China, right? If we slow down, at least on the Silicon Valley side, if we slow down, that gives the lead to China. But then, like you said, Kelly, there's sort of these common sense protections. And we've talked about this before. In a way, China does have its eye on safety. It's just not as political as it is here.
Right, or I think most people would be behind. We just want to know if something's made by AI. Certainly in the deepfake case, but even a commercial. We were talking about this with Mark yesterday, Mark Jackson. And so we just want to know who generated it and where did it come from. So I think things like that,
Have you seen some of the new video generation tools? There's one from a Chinese company, ByteDance. It's called C-Dance is their new model, and it's blowing up right now because it is just so good. When you talk about not knowing whether something's AI or not, it's here.
Exactly. Deirdre, thank you, as always.
Thanks.
Deirdre Bosa. Coming up, commercial real estate. It has an AI problem today that we were just talking about, but that same AI issue is a catalyst for the data center REITs. Names like Equinix, Digital Realty, and Iron Mountain are trading sharply higher. Equinix up nearly 13%. Just shows you the AI trade has a very different impact just within one sector. And on the residential real estate front, some ugly numbers today. Real estate power player and TV personality Ryan Serhant says the American dream is changing. He joins us next as the 30-year fixed mortgage rate is still around 6.12. We're back in a couple. A really big miss on existing home sales today. You have to wonder if that's partly what took down the market. Diana Olick has the numbers for us. Diana?
Yeah, and Kelly, after announcing the January numbers, the Realtors' chief economist, Lawrence Yun, called it a new housing crisis. He said movement is not happening and Americans are, quote, stuck. And the numbers back it up. Existing home sales in January dropped over 8% from December, way more than the street was expecting. Sales down just over 4% from the year before. That is the slowest pace since December 2023 and the biggest one-month drop since 2022. Now, this count is based on closings, so it's contracts likely signed in November and December, when the average rate on the 30-year fix did not move a whole lot before dropping in January. Inventory came down from December, still up 3.4% year over year, but Yun said that is not enough. Now at a 3.7-month supply, 6 months is considered a balanced market. And that kept prices in the positive. The median for January was $396,800, up 0.9% year over year. But that did hit the highest January price on record. It's also taking longer to sell, 46 days versus 41 in January of last year. Sales are strongest on the higher end of the market. The only price category to see year-over-year gains was that $1 million plus range. The lowest price range saw a 13% drop. Now, Lawrence Yun was quick to point out, Kelly, that this is nothing like the foreclosure crisis during the Great Recession, but we are starting to see more borrowers underwater on their mortgages.
So more borrowers are underwater, but his real, he called it a crisis, did you just say? And the issue is, he says,
a new housing
one's
crisis.
moving, a new housing crisis, because no one's moving and there's no inventory, basically, is what he's saying.
Right. There's an inventory problem. Even though it's up year over year slightly, I believe that 3.4%, he said we need many, many, many more homes on the market. And he also said that, you know, for upward mobility, people need to move upward. That is, moving out of the small condo to the bigger house, or moving from a rental apartment to a single family home that they own in order to build wealth. He said it's not happening. People are, again, quote, stuck.
All right, Diana, thank you. Our next guest says the American dream has moved on from home ownership to never leave your home if you're lucky enough to own one. Ryan Serhant is founder and CEO of Serhant Real Estate and executive producer of Owning Manhattan. Ryan, it's great to see you again. I mean, just pick it up where Diana left off and what Lawrence Yun is saying, because I think you're saying something very similar.
The word crisis is a trigger word for me, and I really don't like it when economists use trigger words for clicks. Nothing against them. I think this is not a housing crisis. I think it's simply a mobility crisis. I think homeowners are actually fine. I think first-time buyers are being squeezed. I think supply needs to meaningfully increase. There's a bill proposed, I think it was passed by the Senate literally this Monday, just happened, still needs final approval. It's not exactly what the bipartisan group of lawmakers put forward to create more housing, which is exactly what we need. So I don't think it's a housing crisis. I think that's a solid headline. I think it's a housing stalemate.
Stalemate,
which
that's
is
a good
true.
word. That's a very good word. That's a very good. But you are, I mean, it's funny because I hear that, you know, we don't want to be overblown about this, but you're the same one, and many people are saying, like, it's worse to say the American dream is over because you can't buy a house. I'd rather we have a housing crisis and still have a dream. If there's no dream, I mean, if it's not a possibility, right, is that how serious it's getting?
I think the American dream is economic prosperity. That's the American dream.
Yeah.
Is to go to bed and not wake up at 3 a.m. wondering how you're going to pay tomorrow's bills. That is the American dream, where you have opportunity as long as you attach it to a get up and go attitude. Having that directly attached to home ownership, as I think one of the greatest real estate brokers in the history of the world, myself, I've never said that before. Because I again, like, I don't want to sit here and say the American dream is broken. I think the U.S. housing market, if we're talking just about this country, isn't broken and it's not dead. I think it's working exactly as it's designed to. And I think even you and I have discussed that before, which is the real problem. I think we built a system that rewards scarcity. I think it protects existing homeowners, which is exactly what's happening. Look at the equity gains in the real estate market across the country, but it punishes mobility, right? Unless you create more housing stock. What was it, 6 months, 3 months ago, we were talking about the 50-year mortgage. Great, if we can lower payments, that's amazing. But the long-term effect of that is more punishment on mobility. And I think prices aren't high by accident. I think they're high by policy, and so hopefully Monday's moves will help with that.
I know, but the whole policy is designed to get people to buy houses. The fact that we have 30-year loans are backed by Fannie and Freddie. Is the Fannie and Freddie, some of the policy changes there, making a difference in helping to unlock the market or bring down mortgage prices or anything like that?
I hope so, but Fannie and Freddie are completely useless if we don't have housing stock. People need to live somewhere, and you'd rather pay your mortgage than pay someone else's mortgage. I think, we created a winner-take-all home ownership story. And also, I think we've spoken before, right? The capital gains exclusion on your primary residence, like U.S. Tax Code 121, right, from the Taxpayer Relief Act of 1997, when the median price of a home was still under $150,000. Why have we not revisited that?
Yeah.
People don't need rhetoric, they need roofs.
And I mean,
so,
it's always ironic to me because you're in Manhattan, which is such a different animal than the rest of the country. But what you're saying is really what the rest of the country, they're saying build it. But I mean, I look around, I'm in Jersey. We don't have a lot of space to build it,
Maybe in a specific town, but I think there's a lot of land in a lot of places. What we have conversations with buyers all the time is you have to determine exactly what's the most important to you. Is it being in this specific location, in which case, yes, inventory might be tight and pricing might be high. If it's having a certain size home, there are plenty of options. January sales, she just said, dropped, 8.4% from December?
Yeah.
Rates slipped to just about 6%. That's the lowest they've been in 3 years. Homeowners are locked in now more than ever. I think the average homeowner now moves once every nearly 9 years. And the bottom of the market is seeing real distress, but there's still plenty of housing there. I think housing permission is a shortage, and I think that's what they're trying to pass through the House right now. I think cities aren't out of land. I think they're out of political will unless we fix it.
Well, K-shaped house, I think we're taking some time from next hour, but I think they'll be nice about it. Brian, thanks very much. Always great to check in with you, Ryan Serhant. And Power Lunch is up after the break. Under pressure, trading to new session lows. Welcome to Power Lunch. I'm Kelly Evans. Brian Sullivan will be back tomorrow. And Jeff Kilberg is joining me here today. He's the founder and CEO of KKM Financial. Jeff, welcome to you.
Thank you, Kelly.
We have concerns about tech and AI driving investors into economically sensitive sectors. Usually they're fleeing out of them. Energy, materials, and industrials are still among the best performing sectors this year, even with some transport pain today. But one Wall Street strategist says not so fast. Investors may be chasing these sectors for the wrong reasons. And is today a glimpse of that? Speaking of tech, it's one of the worst performing sectors right now. Software falling again and on pace for its 5th straight week of losses. A close look at some of the biggest losers in the space as AI disruption fears continue to mount. Plus, Coinbase downgraded to sell, a double downgrade, in fact, ahead of earnings. The analyst behind that call is here. And a headline crossing just moments ago that some of its customers are unable to trade on the platform. We'll tackle all of that with Coin down 8% and down 50% in 3 months. Let's begin with the sell-off on Wall Street today. It's red across the board. Dow's down 500, pacing for its worst week since November. So what should you do with your money right now? Basic question. Let's bring in Chris Zenek, the chief investment strategist at Wolfe Research. Chris, what do you make of this market?
Hi, Kelly. Thanks for having me on. It's a manic market. Some of the price action doesn't make a lot of sense in recent weeks, and we turned cautious a week ago into where we saw that blow off top in silver and gold. And to me, and based on the work we do and how earnings season has fared, it's not in many cases being driven by fundamentals. In fact, the most positive EPS revisions this earnings season have been in energy, communication services, financials, and tech. And some of the areas that are outperforming, materials, industrial staples, and even energy for that matter, are the ones that people are chasing here. So I think it's money flow. I think it's rotation. I think those rotations then build on themselves because there's price signals that quant funds and others use to chase short-term momentum. And what started as a software problem has become a much bigger market one. And the carnage beneath the surface is so much worse than what we're seeing at the index level.
Can you illustrate that, such as?
Such as if you look within sectors, for example, within tech, you have some groups like semis still working and outperforming. Those have become even more crowded, where software is underperforming. In staples, you have the food names and other names that are still being left for dead, but then you have the biggest weights, tobacco, Costco, Walmart names ripping higher, right? And the staple sector now is trading at levels that we haven't seen since the late 1990s. And it's a defensive group, as you know, right? It shouldn't be a group that's outperforming when the economy is going to reaccelerate into this tax stimulus. So there's a lot of carnage, weird factor rotations underneath the surface. And I think it's going to take a little time for that to play out.
Jeff, you want to chime in on that? Or?
Well, Chris, I think you bring up a great point. And what's fascinating to see is this dispersion. But it seems like there's a lot of torque in the market. And now with the VIX going over 20 for the 3rd time since January 1st, here we are again in a repricing or a price discovery mode. So despite the fact that it is manic and it is a little spastic, we're only 2% off the all-time high in the S&P 500, and one of that percent is today's downdraft. So are you looking at opportunities? Obviously, energy, staples, and industrials have led the way in the S&P 500 sectors, but is there anything specifically in the stock that you see that we're not?
Beneath the surface, right? So you can get index volatility pickup. First, you get it as a single stock pickup, and there's a lot of dispersion in the market. You're right, there's not a lot of fear. If you look at put-call ratios, those are still very well behaved. And then the areas that we think are, frankly, the most interesting are still telecom services and financials. The one thing that troubles me, though, is the financial sector. It looks like it's going to break some key support levels here. And, with transports now rolling after some of the news today and financials not behaving, particularly the banks, but it's the whole group, that gives me a little short-term cause for concern here.
I'm glad you mentioned that because it was literally 3 or 4 days ago. We'd say, look, the Dow transports are at an all-time high, nothing to worry about. Dow theory is intact. Look at the financials, it's a cyclical recovery. Now we're seeing both of those sectors sell off. Is this just an overdue correction from 2 areas that had been so strong? Or is that how it always looks until it's something more meaningful?
Well, I think in industrials, it's a tale of 2 cities. One is the names that are levered to AI build out are doing very well, whether it's Caterpillar, GE Verona, or Vertiv, or other names. So those names, I think, have the continued momentum, though they are very crowded, right? There's a lot of people that have piled into those names because they don't want to own software. On the other hand, the more cyclical, shorter cycle groups, the truckers, the rails, and the like, have ripped after we had this relatively strong ISM manufacturing report, which frankly I think is a head fake, but until proven otherwise, the market will run with that narrative. So I think we're starting to see some divergence within industrials after some, panic buying, if you will, over the last couple of weeks.
All right, Chris, thanks. We'll leave it there for now. Chris Senek highlighting the strangeness of this market. Wolf Research Chief Investment Strategist. Some breaking news out of Washington. Let's get to Emily Wilkins. Emily, what's happening?
Kelly, it looks like the Department of Homeland Security is going to be in for a shutdown. Lawmakers did fail to pass funding just now. They needed 60 votes, came up short. Democrats, of course, all but one voting against because they still are trying to push for reforms to ICE, Customs and Border Patrol, of course, following everything that we've seen over the last couple weeks in Minnesota and elsewhere. We know that the White House and Democrats have been exchanging some paper and some ideas on this. We heard Senate Majority Leader John Thune say yesterday that he does feel that there is some middle ground, but it's going to take time to really flesh out what, if anything, an agreement looks like. And it's not clear exactly how long the DHS will be shut down for. Lawmakers are out of town next week, although they are on standby to come back if there is an agreement. But of course, on the line, it's not just ICE. This is the agency that oversees the TSA. That could lead to issues with airports, FEMA. That could be a problem if there is a natural disaster, and a number of other things that they do as well, including the Coast Guard, all set to be impacted by a shutdown. And we'll be watching to see exactly how long it lasts and if there can be an agreement when lawmakers come back from their 1 week break. Kelly?
So, Emily, with the failure right now, does that mean the partial shutdown is now guaranteed?
Yes, I mean, Kelly, for the lawmakers who I've talked to, maybe there's some sort of last-minute miracle and they're able to put something together, but no one in this building believes that that's going to happen. Lawmakers are currently on their cars to get to the airport, to fly back home. They've been told that they will be on notice if they need to return to D.C., but I think many of them are even planning to go overseas next week because they just don't see an agreement coming together anytime soon.
Wow. All right, Emily, thank you for now. Really appreciate that update. Just watching the markets here. Again, the Dow's still hanging on to a decline of about 500 points. That's Emily Wilkins on Capitol Hill. And Amazon, the other mega cap techs, they are squarely in focus still. 5 of the 7 are lower for the year. And among the biggest laggards is the one you're looking at right now. Amazon down 2% on a 7-day losing streak and on pace for its first 8-day slide since 2019. We're also keeping a close eye on shares of Apple today, which is now down more than 5% at session lows. Its worst day since last April. Could be something about a delay in Siri. Our next guest is underweight the Mag 7 and is keeping his portfolio nimble to find opportunities in this market. Adam Phillips is Director of Portfolio Strategy at EP Wealth. Welcome.
Thank you.
Okay, so let's back up for a second. In Mag 7, you think emblematic of the problems we're having, so you just steer clear of them, you'll be okay, or are we seeing broader problems?
Well, no, I think what we're seeing is a more discerning investor. So right now, we are seeing the Mag 7 is really the biggest source of weakness. I think there's this tension right now. There's this tug of war. Seems like every day we're rotating between people are worried that we're not going to see the payoff from all of this CapEx investment. The next day, we're hearing that it's going to be too successful. It's going to put these software companies out of business. So I think that remains to be seen. We've been underweight the Mag 7 for some time. What we've been telling our advisors and our clients is it's okay to look different than the index. Sure, we care about tracking error, but we're focused on diversification. So some of our biggest holdings are still those Mag 7 companies, but they're significantly smaller than the S&P 500 weighting, and that's deliberate. And so we think that there's opportunity outside of this AI theme.
I think that's great, Adam, and you're beating to my drum because we've talked about this great rotation for quite some time. But when you see that, yes, today, folks, we're not seeing the AI robots take over the world, despite the fact that's what the tape feels like. But when you talk about 65% of the S&P 500 outperforming, and you see that Mag 7 continued internal rotation, what are you looking at right now? Because the ExxonMobils, the Costcos, the Ciscos, the food company, these are blue chip boring names. Is that where we should be? Because you're speaking my book if you are.
Yeah, look, there's nothing wrong with boring, and that's what we've been saying, is that...
Well, there's something wrong with boring today if you look at Cisco. I mean,
that's true.
Cisco, the food company.
Thank you.
Is up 2.5%.
Yes,
yes.
But I think that boring, it does not have to be AI associated with AI in that theme. I think boring is okay in this market. We've seen the run that these companies in the Mag 7 and broader technology we've had over the last couple of years, and it's okay to look for other opportunities. That's how we're playing it right now. You can still express conviction in that theme, but let's take our foot off the gas pedal a little bit, and so that's what we're looking at.
Let Adrian in the back put up SYY just to clarify. Yes,
the same face. Thank you.
System. I don't want anyone to think that Jeff is saying that Cisco's not stuff. Although like you said, so even for those guys who have said, fine, I've been thinking about the Mag 7. It's been a comfortable place to be. Now you're telling me to go out on a limb into these cyclical areas that on a day like today, I find myself getting whipsawed in the transports, for instance. Can you just kind of chime in on that?
Yeah, absolutely. Well, look, I think that, as I said, you can have conviction in AI still, but be mindful about it. I think what we're seeing right now is the risk of overstaying your welcome in certain trades that have maybe run a little bit too far. And so I think this is a rotation. This is not something that's going to be short-lived. That's how we feel. And so what we are looking at is the fact that, yeah, some of the cyclicals are getting pummeled right now, but our economic outlook is still positive. When we have a day like today, we're going to take a step back and ask ourselves, does this derail the earnings story? Is this really going to change the long-term narrative? We don't think that it does.
And just to put a couple sprinkles on Adam's cupcake there, Kelly, I think if you equal weight that narrative, that's the secret sauce, because equal weighting has really been dramatically reducing that downside draft, which we're seeing today. Look at RSP, down 1%.
Yeah, I didn't want to hear about equal weighting. I didn't want to hear about international stocks. And now that's the best places to be in this market. That's how it works, I guess. Adam, thanks very much today. Adam Phillips from EP Wealth Advisors. We're going to take a quick break. Roses are red, guys. So don't know if you know. Violets are blue. And $1 million partnership, well, it may be through. Coming up, the latest sign that Microsoft and OpenAI could be drifting apart. Welcome back. We have some news on Anthropic's latest funding round. Let's bring in Kate Rooney. Hi, Kate.
Hi, Kelly. So Anthropic announcing a blockbuster funding round in AI. It's a $30 billion Series G, valuing the tech company at $380 billion. It is about $10 billion higher than what I was told that funding round was going to be just a couple weeks ago. It does also top some of the biggest IPOs in history. I'm told there was strong demand here for Anthropic from investors at the 11th hour. The round was led by GIC and Coatue. You also had Microsoft and NVIDIA participating, although it is part of a portion of what they had previously announced they were going to invest. A handful of banks also involved. You had Morgan Stanley and Goldman, for example. As we have reported, Anthropic is among the companies potentially prepping for an IPO as early as this year. Anthropic, best known for its coding offering, B2B business as well. Also got some revenue numbers in its release today. Run rate now $14 billion. They say it's grown more than 10x annually in the past 3 years. So the number of customers spending over $100,000 annually, they say, on Claude grew 7x in the past year. And then they now have more than 500 customers spending $1 million or more annually. The number of weekly actives on Claude Code as well. This is sort of that buzzy code offering. That doubled in terms of users this year. Revenue run rate topping $2.5 billion for that section there. And then finally, business subscriptions for coding quadrupled this year. It does come, Kelly, as we see fierce competition in this enterprise space with OpenAI in particular.
Yeah,
Back to you.
This, Kate, thank you very much, Kate. This is bigger than any IPO we've ever had. I mean, $30 billion is a huge, I think Saudi Aramco wasn't even that large. And with Microsoft being part of that new Anthropic funding round, could it put more strain on the relationship between Microsoft and OpenAI? Could it help the shares of Microsoft, which have been lagging? In an interview with the FT, Microsoft's AI chief, Mustafa Suleyman, saying it's pursuing true AI self-sufficiency by building its own powerful models and reducing its reliance on OpenAI. Microsoft has invested more than $13 billion in OpenAI, holds a 27% stake in its for-profit entity following a major restructuring in late 25. Joining us now is CNBC's technology correspondent Steve Kovac. So, Steve, welcome.
Yeah.
And react to the Anthropic round, to what Microsoft is doing.
I mean, this ties in beautifully with what happened with Anthropic. So we don't know how much Microsoft just put into Anthropic, but they did say they're going to invest up to $5 billion, and that would have been just unheard of a few years ago. Oh my God, Microsoft is getting in bed with Anthropic? What about OpenAI? But this is what we've been seeing over the last couple of years, is them slowly drifting apart. I know Valentine's Day is coming up soon. I would call it, it's almost like they're in an open relationship with each other now instead of just married to each other. They're able to do deals with other cloud providers. Microsoft has more bandwidth now to go out and do deals with Anthropic. They're incorporating Anthropic into more and more of their products. And now we hear from Mustafa Suleyman, the CEO of AI over there, that they want to build their own frontier foundational model to compete directly with OpenAI. And this, by the way, Kelly, I spoke with Suleyman about 11 months ago over at Microsoft HQ. He told me the exact opposite. He said, we kind of like using OpenAI, even though we might be 3 to 6 months behind the technology that they do incorporating into ours. It allows us to make this stuff cheaper and more efficiently. Now he's singing a different tune.
All right, Kilberg, you've got your list over here. I don't want to call it dumpster diving. That'd be unkind. These are great companies, but it's been a big move down. Do you look at a Microsoft now, which is trading at one of its lowest PEs in maybe years now, if I'm not mistaken, and with the news or thinking through, is this a time for investors to get in?
I think it is absolutely a time to add on to some of these main staples. I think the Microsoft, look at Amazon. Amazon is down dramatically from its last earnings report, where previously when CEO Jassy talked about needing more AI, more capacity because it turned into more revenue. That was in 2025. Now they talked about spending more in CapEx at the last earnings call, and they're being punished for it. So this type of reaction, I think, allows you, but I'm also looking at Palantir. I'm also looking at Apple. Apple's down 5% today. It's remarkable to see a name like that. And lastly, here's a hot one, Kelly. Rigetti, RGTI. So that's the quantum computing, small $27 billion company, down 75% from its all-time high. So I think there's an opportunity to dumpster dive, but also to add some blue chip essential names that we can.
I heard you mention Microsoft in there. I heard you mention Apple. Steve, is this Siri issue what's at fault today?
That's part of it, yeah. I mean, besides the broader market itself. So what we saw at Apple yesterday was Bloomberg put out this report, that upgraded version of Siri that was supposed to incorporate Google Gemini and all those things that they promised way back in June of 2024. We were expecting that to launch in just a few weeks. Now Bloomberg reports only some of those features are going to come out in May and perhaps be kind of elongated and stretched out over the course.
To break hearts. I know.
Yeah, exactly.
Why do they bother?
So disappointing.
Who cares anymore?
Now look, Apple tells me, oh, it's not delayed because they only said 2026. So technically, it's not a delay until December 31st at midnight. I get it, but everyone kind of knew this was on the cusp of launching, and these kind of quiet pushbacks internally are just not good to build confidence that that, hey, they finally have the grasp on artificial
And that is a
intelligence.
partner with Gemini.
That's
correct?
this is the Gemini product, yeah. And keep in mind,
If they wait long enough, they'll have Microsoft to pick from.
June of 2024 was when they originally announced this.
And Gemini is superior.
Yeah.
I love using
Wonderful.
Gemini.
That's what I use.
But I need Siri. I need Siri to change your name. I need Siri to do something
I
different.
just try to make phone calls with Siri. Hey, Siri, call.
Believe me,
call
Apple
Mom.
knows all these issues are
But
there.
from a stock perspective, it's being overpriced. It's being overreacted. To be down
Absolutely.
5% today, absolutely not.
And by the way, with the AI picture, they've proven that they can just sell these phones without even having AI. The
Correct.
iPhone 17 cycle, just gangbusters, especially in China.
Exactly. I mean,
and
seriously.
so maybe they don't even need this AI
Maybe
stuff.
they don't. Just to quickly darken the mood before we let you go, Steve. In that same interview with the FT, Suleiman was also asked what he thought the broad impact of AI would be. Take a quick listen to what he said.
I think that we're going to have a human level performance on most, if not all, professional tasks. So white collar work where you're sitting down at a computer, either being, a lawyer or an accountant or a project manager or a marketing person. Most of those tasks will be fully automated by an AI within the next 12 to 18 months.
And we were told that literally the reason why commercial real estate stocks are selling off today is on this concern that there will be fewer jobs.
Yeah,
literally
exactly.
Less office space being rented going forward.
And we hear this from all the AI leaders, right? Dario Amodei over at Anthropic said, half of all entry jobs are going to be nuked in 1 to 5 years. So look, we'll find out in 18 months if Suleiman is right there. I just want to point to Copilot, because that is their main product that's supposed to do a lot of what they're saying. It's supposed to make you more efficient and easier, and maybe you don't have to hire as much. They've only sold 15 million seats of Copilot out of a total group of 450 million seats. It took them over 2 years to get to this point. So they are doing a pretty poor job right now of convincing people Copilot is good enough to do what they
They spend a ton
say.
of money trying to convince people.
They spent a ton of money, Super Bowl ads, you name it, and not this Super Bowl, but a previous Super Bowl, and it just has not played out the way people thought it would. People are going to OpenAI Enterprise, they're going to Anthropic, they're building their own bespoke tools built on those foundational models. They're not buying Copilot in a significant
Now
way.
investors are arguing whether they should just back away from those efforts
Yeah, we heard that
altogether.
last week,
That'll be
yeah.
a chapter to come. Steve, thanks.
Thanks, guys.
Steve Kovac. From big tech borrowing to the broader bond market, Rick Santelli joins us next with the latest on what's happening in the bond market. Stay tuned. Welcome back. Maybe it's because it's a risk-off day in the markets, although the Dow's slightly off the session lows. Maybe it's the data. The 10-year yield, though, has finally made a kind of decisive move lower, and it's back to its lowest level since early December. In fact, Rick Santelli has more from Chicago with a special guest. Rick?
Absolutely. And I'll tell you what, Kelly, this is a big day for a variety of reasons, not the least of which is Jerome Schneider from PIMCO. Jerome, it's always a pleasure to talk to you. You're the voice of the fixed income markets. So let's get right into it. Yesterday, jobs number was delayed, but it was very powerful. What are your thoughts now that it's simmered for 24 hours?
Well, the delay was a surprise, obviously, to the upside, and the market's simply been taking that in digestive form. Obviously, today's market reaction is more to do with auction strategies more than the jobs number itself. But the market, and really the jobs market itself, has been a bit under tension, job creation versus job layoffs. And a lot of the big job layoff announcements should be expected on a regular routine basis as businesses adapt to the new landscape, especially with productivity and AI and things like that. The other thing, though, is to remember is that the economy continues to chug along. When you look at the weekly jobless claims, they've been between 210,000 and 240,000. Pretty steady along the way, and although we might react as traders to the minutia, overall investors should be really aware that the economy continues to do fairly well and will continue to do better as we continue to focus on the fiscal stimulus to come in the first and second quarters of this year.
I like the way you're commenting on labor. So it basically is the Fed thinks it's weakening, but much of that's anecdotal. A lot of the data looks pretty firm yet. Now let's go to the other side of the street. What about inflation? Before tomorrow's January CPI, and we're expecting most of the metrics to come in a little bit cooler, like the year-over-year numbers. Thoughts?
Right. Market's on edge because they were expecting inflation to cool down minute by minute. And expect at PIMCO, we think you're going to probably get 2.5% year-over-year number. Reality is we're going to see inflation creep up over the next few months closer to about a 3% core. Is that going to be alarming to people? It shouldn't be, because we see that in the numbers happening. Over time, they'll come back down, and that's going to give motivation for the Federal Reserve to contextualize and put into their calculus potential rate cuts later on this year. Again,
now, if you think it's going to be a little bit higher, I can't disagree with that. However, if it's that far away from the Fed's 2% target, how much will that weigh on the Fed's decision in terms of their easing and their strategy for 2026?
Well, I think it's two things in that strategy. Number one, everybody's focused on the new nomination of Warsh to be the chairperson. That's one aspect, and that creates a little bit more dovish bias to the Fed in addition to other factors. But remember, it's a committee, and that committee bias has been clearly transparent in the fabric of the FOMC and the decisions. There's been dissents, and as investors, we should get comfortable with those dissents. That means there's healthy debate going on. And as long as there's healthy debate going on, we're going to see them rationalize the jobs and inflation metrics in addition to all the other factors going on into the economy. And that potentially puts that debate more in focus later on this year than at the front end of this year.
Okay, the last issue, and I want to cover it quickly, Japan. Many believe, including myself, that there's a big influence in our markets, global markets, from Japan as they approach 250% debt to GDP, and now they're throwing out more debt and looking to have more stimulus. Final thoughts
Clearly,
there?
there's some transformation going on in Japan, which is having influence on global yields. From a portfolio manager point of view, it's one of the most exciting times in almost 2 decades where you're having divergence in global yields. That means that there's opportunities as we create that differentiation for higher income, higher possibilities. And so, as we would say, just look out for the opportunities, steer clear of the risks. Don't be placated by the tight credit spreads and thinking that's the only way to go. Fixed income is a wide, diverse global world, and this is an opportunity set that makes exciting opportunities.
Excellent. Jerome, always right into the intricacies of the market. Kelly, back to you.
Great stuff. Thank you guys very much. As always, Rick Santelli with Jerome Schneider there. After the break, we're going to take a deeper look at that 100-year bond from Alphabet. Could it be the sign of a debt-fueled AI arms race? And where is that taking us? We'll discuss next. The corporate debt market just keeps getting bigger this year. We have more debt issued now from another huge player in the AI race this week. CNBC confirming that Alphabet raised more than $30 billion in its mega bond offering, including a 100-year bond that has attracted a lot of attention. And of course, we've also had Oracle raise $25 billion of debt this year. Meta, Amazon, and Tesla are all expressing interest and raising money that way through the debt and equity markets, which raises the question, is all this demand for hyperscaler debt a green light for AI spend to continue? Or not? Here on set with us to answer that is Fundstrat economic strategist Hartika Singh. She's out with a note this week taking a look back at some of the other companies that have issued 100-year debt to see what that might forebode for, or just bode, I guess, for Alphabet and AI. Hartika, it's great to have you here.
Thanks for having me.
So everyone's talking, what was it in 99? Motorola was the big one? Okay,
Yeah.
but widen the lens for us. How else should we be thinking about 100-year debt?
So thinking about just the age of Google and these Magnificent Seven companies, they're not that old. They're pretty young. You know, Google itself is 28 years old, and all the Magnificent Seven companies that we've had, they were created in the last 50 years. And then, to put that into perspective, AI itself is 3 years old, and Google's just taking a huge bet on it with this $100 billion bond offering. Putting into perspective, other century bond offerings were done by companies that were, you could say, boomers in their age, right?
Really? Is that right? Was Motorola like a 60-year-old company?
Yeah, yeah. And
so do you generally say this from the point of view of it's better? I'm trying to pick an analogy that doesn't sound, to try to, take the medicine for hair regrowth, right? I mean, is it better for them to chase this idea that this CapEx will make them young again? Is that how it actually ends up working or not?
That's a big question on my mind right now, especially because let's take, for example, Disney. When they've had their century bond offering, they were about 70 years old. And even back then, there were all these concerns about the entertainment industry, especially back then when there were many questions about how it was going to revive itself. People in the Wall Street Journal, when they gave quotes, they said, oh, this is kind of a silly idea. This is a crazy thing. Look at what happened to Coney Island, for example. So I think it's just a matter of, can you as a company keep disrupting the space you're in and reinvent yourself? Because it's 100 years. It's a really long time.
Yeah.
Well, I think Google, from the diversification perspective, they continue to be like their own little Berkshire Hathaway. So it is interesting they're coming to market, but the subscription, the oversubscription, it really talks about the appetite in a time when should investors be concerned with these 100-year bonds, which are remarkable. Maybe we live to 100 with all the robots about to help us, Kelly. But what we see is the appetite for this. We're about to have SpaceX potentially this year, which is going to be the largest IPO of all time. Meanwhile, you're seeing $25 billion, $30 billion from Amazon, from Oracle. Should we be concerned at what point of this financing really is the undercurrent in the marketplace?
Yeah, there's a lot of demand right now for these bond offerings, right? The oversubscription, my eyes just pop. Yes. 10 times. That's crazy. But again, I know these big tech companies, they've lost their cult-like status. But at the end of the day, the oversubscription kind of shows to us that, investors haven't completely given up on these big tech players yet. And I think that's a really good sign for the broader market because there's such an outsized portion of the market. If they don't rally, how hard is it for the broader market to keep pushing to all-time highs? And right now with the software stumble, I'm really thinking about that.
When you went back and looked, did it make you come away from it? Because I love hearing about the stories we've forgotten about. I wish I could do a whole series of the news we've forgotten, right? The Disney one you mentioned is so fabulous. Does it make you look back and think, you know what, these companies should have been more aggressive because all of these concerns were overblown? Or does it make you think, no, these typically were the signs of a business model at its peak and they didn't see that the cliff was coming?
That's a great question. I think that, yes, some of them should have had the oversight. For example, JCPenney, they also had a 100-year bond offering back in the late 90s.
Wow.
And guess what? They went bankrupt 23 years later. So the bondholders for the 100-year bond, they got nothing out of this.
GM was a bad one too.
Yeah.
Was that as long as about?
Well, the bondholders got.
But was it a century or 30 or long term?
It was longer.
Yeah.
It was longer. Yeah.
Wow, for GM.
Yeah. So with the duration risk too, it's like you can make the money back, but at the end of the day, if you are a long-term insurance company, for example, you have long-term liabilities, you're a hedge fund, you are looking for, high convexity, you kind of want the bond to continue paying out for the duration you thought it was going to.
Yeah, even if that, I know a lot of people, it's not 100 year, it might be 30, depending on how you look at it, but that's fascinating, those analogies. Hardika, thanks for doing the deep digging for us.
Thanks so much.
Come back anytime. I think we're gonna have a lot more of these to come. Hardika Singh joining us there from Fundstrat. And we do have a market flash on the commercial real estate names. Diana Olick has the details. Diana?
Well, Kelly, AI strikes again, this time hitting commercial real estate services companies. CBRE, JLL, and Cushman & Wakefield all down over 20% in the last 2 days. Oppenheimer noted there have been only 2 periods of time where the stock has fallen more: COVID and the global financial crisis. Now, CBRE CEO Bob Sulentic addressed AI on the company earnings call this morning, saying about the brokerage side, we've become quite confident that that business really is driven by this strategic, creative thinking that our brokers do, and we think that's going to continue to be the case. But he added that they are using AI to get more data to their brokers more cost effectively. He said, we think we've turned the corner on that with the use of AI. We're pretty encouraged in some tools we've built. Now, commercial broker Newmark is also getting hit. Piper Sandler's Alex Goldfarb wrote this morning, AI fears have cycled through various industries recently, including software and insurance. So it wouldn't be surprising if, in fact, these same concerns drove the broker's sell-off, but he remains overweight on the stock and calls it a buying opportunity. Back to you, Kelly.
Diana, thank you very much. Diana Olick. Let's get over to Kate Rogers now for the CNBC News Update. Kate?
Kelly, retired Navy captain and Senator Mark Kelly issued a statement this afternoon calling a judge's decision to block the Pentagon from punishing him a critical moment. The Arizona Democrat says the judge's decision shows the Trump administration cannot keep undermining Americans' rights. The Pentagon is trying to reduce Kelly's rank and cut his retirement benefits for his participation in a video with other lawmakers calling on military members to resist illegal orders. A federal judge is ordering the Trump administration to allow Venezuelans sent to El Salvador's notorious Secot mega prison to return to the U.S. if they want to come back. The ruling impacts around 130 men who were held for 4 months at the prison. Judge James Boasberg said they were denied their constitutional rights before they were deported in July as part of a prisoner exchange. And the Senate Commerce Committee passed legislation today that would speed up the approval of new satellites to extend internet service across the U.S. The bill would streamline the FCC's licensing process. Kelly, back over to you.
All right, Kate, thank you very much. Still to come, the landlords of the AI revolution. While everyone is keeping a close eye on the chips and software, our next guest is looking at the real estate that helps power it all. Those names when we return. Welcome back. It's time for our Market Navigator segment today. And when it comes to AI, the story certainly doesn't end in chips or software. Our next guest is looking at the real estate that powers it, including one name that's soaring today to 52-week high after issuing better than expected full-year guidance. And no, it's not the gym you might have worked out at. Jan Salagi is CEO and co-founder at Reflexivity. And you say that Equinix, Jan, is the landlord for the AI revolution. Why them in particular?
Yeah, so they are really the largest player in what I would call is part of the AI infrastructure. They own a number of data centers. It's effectively where Google, AWS, and so on are locating their services. A number of other businesses do as well. And so I think it's a really interesting way to get involved with the AI story without paying for the multiples that you have to when you are only buying and going along things like chips.
What about the other data center stories? I mean, even Galaxy Digital has an AI data center. There are Bitcoin miners who are getting into the data center game. There's going to be a lot of competition in this space.
Yeah, you're right. It's an incredibly fragmented space, but actually I think that speaks in their favor. They're the dominant player. I think there are what I guess you would call network effects here, because the more businesses and ISPs and so connect into their center, the more attractive it becomes for others to locate there as well. And so I think they're going to benefit from that as well. Being the largest player there gives you potentially extraordinary advantage versus everybody else who might be doing one or two of these.
How big a backlog, so to speak, do they have if they talk in those terms? And, you know, we also hear about how Amazon is so capable in the data center build out because they have such experience with their warehouses. And a lot of this is getting the staffs and the permits and the land clearing and all of that to happen. So how would you compare Equinix's favorable position even to others in the data center space or in Amazon?
Well, the key here is that they are focused on just data centers. So Amazon obviously is an incredible company, but it's doing a lot of different things. These guys, all they do is focus on building and delivering excellence when it comes to data centers. So I think that that does give you a certain competitive edge that they are taking advantage of. So I would say, yes, there might be competitive threats that emerge, but even for AWS or Google and so on, ultimately, so long as it's competitive, it kind of makes sense to outsource some of these services to a player that just does it extremely, extremely well.
Yeah, and they are up 12% today. Based on how you value them, where do you think the stock should trade?
I think even if you just look at, and so this is obviously something that the street has already realized, the average target currently has them 20% from here. I think that as you see this fragmentation turn into consolidation, and just for the next 12 months between the 4 top tech players, $400 billion in spend on AI, probably $1 trillion over the next 5 years, there is going to be an enormous amount of demand. So I would say, 30-40% from here is just from the infrastructure play, let alone the fact that they pay a dividend, which in the environment where the Fed is cutting rates is another plus.
Yeah, and $1 trillion could be conservative based on the numbers that we're seeing. That could be annual in a couple of years' time. Jan, thanks very much for joining us today. Jan Salagi.
Thanks for being here.
And Coinbase has gotten clobbered this year. Now it's getting hit with a rare double downgrade to sell from buy. The analyst behind that call joins us ahead of the company's results. More pressure on Coinbase today. The shares are down more than 6%, bringing its year-to-date decline to about 37%. And that's after getting hit by a double downgrade from buy to sell ahead of its results tonight. Shares of the world's largest crypto exchange have already been off to a rough start this year. Let's bring in the analyst behind this call, Gus Gala, Senior Equity Research Analyst at Monness, Crespi, Hart. Gala or Gala, Gus, welcome.
Gala. Thank you, Kelly.
Thank you. I apologize for that. Jeff Kilberg is here with us as well. To do such a bold, well, let me rephrase. Look, it's not that, but obviously the stock has had a tough run. But the boldness is to now double downgrade ahead of earnings. What if this is the turning point in which they surprise us all, pull some rabbits out of their hat, and turn higher?
We have decent visibility into like the volumes during the fourth quarter. So on the transactional side, that'd be truly quite a bit of a surprise. It really comes down to a call on the length of the cycle. Typically, using Bitcoin as a proxy for crypto, the down cycle historically has been 350-ish days. Right now, we're on day 130-ish. So just seems like there's a couple of quarters before you're getting the really good entry points.
So some would look at this, Gus, and say you're just, following the stock action, which is down sharply. But what you're saying is that what's changed or from where you sit, is that we now have conviction that this is one of those down cycles. How many days does it take to know that you're definitely in one?
I don't think you know necessarily how many days you are necessarily, but I'll give you this as an example. The shortest down cycle on record was about 140-ish days. So we're around there. All the other ones are 300 plus. So just looking at the whole ecosystem, and then we get into monthly actives and downloads for the 5 large crypto exchanges we track for consumer. The downloads are down. The MAUs are down, like large double digits. So yeah, but there's going to be probably, based on history, at least a couple more quarters of pain.
Hey, Gus, it's Jeff. Just to jump in real quickly, Gus, I read your note. I found it interesting, a lot of points. But just from the trading perspective, we're seeing Bitcoin now at 66,000. Of course, hindsight's 2020. This would have been a great note when Bitcoin was trading 126,000. But that's not the case. I'm a portfolio manager. I fully understand. But when you're talking about the duration of the bear cycle of Bitcoin, which is certainly the proxy to coin, we're also seeing HOOD come off its all-time highs. But with coin being down 65% off all-time highs, where do you see that target in Bitcoin? Is Bitcoin going to 50,000, 40,000? And where can you potentially reverse this double sell, this double drop on your note for Coinbase?
Yeah. So the thought process, and we'll give a little back context here. We'd upgraded it in November thinking, hey, what we saw in the cycle, it's about half of what we've seen in prior cycles. There's more of an institutional asset base in this now. You'll get a cleaner recovery. That's not played out. So we're thinking, hey, it's going to be a slightly longer down cycle. What will we want to see? I mean, estimates need to come down. That's I think the big byline in the note for calendar 26. Probably we're seeing some kind of recovery year end, but again, hard to pin the tail on the donkey on that one. But it's fairly. We're still constructing on the company over the long run. Mm-hmm. We think it's the valuation benchmark to the ecosystem, right? But the next 6 months, just based on historical crypto cycles, probably you see some kind of sideways action optimistically. Yeah. And then you got to consider the whole regulatory side of things. Things have gone turbulent, to put it nicely.
Mildly, yeah.
Fair enough.
Yeah.
Gus, I really like your point there about how you thought this institutional would provide a different kind of bear market here, but in fact, it's not. It's kind of more like it used to be. I appreciate you joining us. Thanks. We'll see how they report this afternoon. Gus Gala from Monness, Crespi, and Hart. More Power Lunch right after this quick break. Don't go anywhere. Another day, and this time it's another rally for the memory. So we were talking to Jeff about this a second ago. So they're either up or down like 8% every time you look. Seagate, SanDisk, and Western Digital and Micron today are this time all moving to the upside. Christina Partsinevelos, is there a catalyst?
Yeah, there is a catalyst, but the disconnect right now with tech and memory just shows where this market is searching for winners and losers. Today, there's a few catalysts with Micron's CFO speaking at a Wolf event yesterday in New York, and he was denying any rumors that their memory chips wouldn't qualify for NVIDIA, so he pretty much squashed those rumors. The stock jumped yesterday. He also said that they're moving ahead with their shipments of high bandwidth memory, HBM4, so that's for Micron. SanDisk in particular, their joint venture with a Japanese firm, did quite well, and they guided yesterday. Kioxia guided higher, and so that bode well for SanDisk. Those are very specific ones. But when we talk about all of these memory players, we have to talk about the fact that somebody is going to pay for it, right?
Yes.
We are going to pay for it in terms of the electronics, but of course,
Cisco's going to pay for it.
Exactly. The original equipment manufacturer. Cisco is a perfect example. Lenovo too. The fact that their margins were hit. Cisco had a pretty strong quarter. AI orders climbed higher. Product, just in general, they're moving ahead with their product offering. Security was a little weak, and nonetheless, look at shares down about 12% because of that margin story.
They just, even the markets bounce a little bit off the lows, but they're down 12%.
Could also be the stock ran up about 15% just 1 month into earnings, that outpacing the S&P 500 as well as the SMH. So perhaps that was part of it.
It's clear we need memory.
And Jeff, you were saying, like, as a portfolio man, you've had these names, like you've owned it, but now the volatility makes you have to.
So Micron was our biggest position in the Mango Growth ETF, ticker symbol Gary.
Nice job.
And we close it in this price action because it's oscillating $30 an hour, it feels like. So we close that position. You never go broke taking profits. We're going to come back in the name, but at the end of the day, memory, that is what we need. It's like the need for speed, the need for memory. It's not going away, is it?
No, definitely not. You have a lot of these, the executives of these companies saying that they've now signed long-term agreements with many customers. So what that means is that the industry is no longer necessarily cyclical, according to them. This is going to create that longevity, which would argue, hey, the stock's going to stay up for a lot longer until it doesn't.
Right, exactly. But it's fascinating to watch how hard I think it was Mark Andreessen who said this week that he thinks ultimately all the gains are going to accrue kind of to the hardware that goes into the physical stuff going into AI, even more so than the players, who we talk about with Anthropic and everyone else in these funding rounds.
You can say it for Intel and AMD with their CPU chips too, and traditionally we would always talk about NVIDIA's GPUs, but there's these pockets of weakness everywhere.
And that's where the opportunity comes. All the dispersion, all the profit taking, all the panic. Everyone.
All right, so Killer, I can't call you Killer, but Jeff, in the final 30 seconds, you mentioned Rigetti. What other things are you looking at amid the sell-off today that you might be picking up?
So we bought Palantir today because we've seen such a price discrepancy. So when we see these names in price discovery mode, that gets me excited as a portfolio manager. So we are trying not to dumpster dive, be considerate about what we want to own for the next 4 to 6 weeks.
Again, if you've had Micron all along, when are you going to get back in? When it's you don't want to stay in it?
It was a 350% winner in 2025. We're going to take a little break and come back soon.
Jeff Kilberg, Christina, thank you. Christina Partsinevelos. That's it for Power Lunch. Closing bell right now.
Kelly, thanks so much. Welcome to Closing Bell. I'm Scott Wapner, live from Post 9 here at the New York Stock Exchange. This Make or Breakout begins with, of course, this sell-off. It's gotten a little bit better, actually, as the day has progressed. Dow is down by more than 600 early on. We've not quite cut it in half, but we're working our way there. So it's a down day on the street. You can look at the scorecard here, and it's pretty widespread, too. Everything down maybe 1%, in some cases 1.5%. Russell 2000 bad. Some of the economic data around housing wasn't very good, and that's caused a flight to safety trade working today. A bit of a bid in treasuries and the dollar. Elsewhere, transports, wow, they're getting smoked, and so is Apple today. Our reporters are standing by with a deeper look at what's actually happening in all of those places. First, though, our talk of the tape, where this market is going after its record-setting run. Well, let's ask one of this country's top financial advisors. He is Richard Saperstein. He's the founding principal and CIO of Hightower Treasury Partners. He's with us here on set. How you doing? Good to see you.
Really good, thank you.
You must be feeling pretty good about the market, a day or here, a day there notwithstanding, because what's notable to me is you're trimming some of what you had in munis, which you've been a huge fan of for, gosh, feels like years now, and you're increasing your stock allocations. Tell me more.
These dislocations present opportunities for clients who don't have enough exposure to technology broadly. So let's look at the hyperscalers, 4 of them. Google, Meta, Amazon and Microsoft, their cash flows are increasing at an increasing rate. The market now is pricing free cash flow, not operating cash flow. So the market is saying, hey, you've got this huge operating cash flow. We don't want you reinvesting it back into the business, in spite of the fact that you have constraints on allocating space. They're starting to allocate space to their primary services, their first-party services, versus third-party services. This is a good problem to have.
So you're undeterred by all of these huge numbers because you may be, but the market obviously is not.
Well, what's the company going to do with their operating cash flow? They're going to either buy back stock, pay dividends, or reinvest back into business, or put it on the balance sheet at 3.5%. I'm voting that they're making the right decision due to the capacity constraints they have. They're making conscious allocations of that with that capital.
I mean, when you look at, you ticked off Google, Meta, Amazon, Microsoft. Let's take Amazon. We're going to have the first 8-day losing streak in that stock in many years, since like 2018, 2019. The stock did nothing last year. So what doesn't the market see? What's it not comfortable with?
If you're a short-term investor right now, you want to be in the non-tech names for the most part. If you're a long-term investor, you want to use this opportunity to add to some of these names. They're just building their infrastructure out for returns down the road. And the key to follow all this is the operating cash flow. If these stocks were going up and the OCF was not, then I'd be concerned. But the OCF is rising year over year over year, and they're plowing it back into the business. So if we have patience, we own these stocks for the long term. That being said, if we really want performance now, and we own oil, pharma, bank, we want to diversify consumer into those sectors for more near-term performance. Josh, he has a great, the halo thing.
Right.
He said that, okay? So for short-term performance, that's where you go.
But as you've learned, one, they're not all created equal, all of these mega caps. They're all having some issues in some respects. I mean, Microsoft, that stock, look at that today. That stock's ugly. Now, software's in the crosshairs. Do you think the software sell-off's overdone?
Yes. So with software, investors should look at IGV, the ETF.
And let me note real quick. Hey guys, we'll go back to Microsoft for a minute because that's helped the Dow get off the mat, helped the market come back a little bit. No, today. Yeah, there you go. So earlier during halftime, we look at it, it's getting creamed, and then it slowly worked its way back. To your point about dislocations creating opportunities, others believe in that clearly.
This stock will be higher in the next 1 to 3 years, much higher. And I wouldn't be selling, I'd be adding to the name right here, because these companies have domain expertise, the software group. And what they're going to do is adopt AI and remain in the pole position in many of these companies. The market is discounting an outcome worse than is likely anticipated. Look at the operating cash flows of ServiceNow, CRM, all these companies. It's going up as these go down, becoming more attractive.
You own those? You own CRM and ServiceNow?
No, I own the IGV.
Would you buy the individual names?
Not right now.
That's dangerous, buying the whole IGV, because then you're lumping everything in a boat that's taking on a lot of water, rather than being tactically selective in ones that may not be dislocated as much by AI.
I'm selective in the larger cap companies, but I'm taking a broad approach with the software companies. Think about this. If you look at the hyperscalers right now, I want to just go back to that for 1 second.
Sure.
The operating cash flow of the hyperscalers right now, the four I mentioned, is greater than that of the S&P, the non-496 names. It's an amazing statistic showing the relative attractiveness of the four stocks I mentioned versus the S&P.
What about the idea that we are witnessing, as some say, like Piper Sandler today, what they call a passing of the torch? And you have intensifying sector rotations. Capital is moving from growth to cyclical to value. That's why other parts of the market are more in favor than tech right now.
Short term, it makes sense.
Just short term.
Yeah, but in the long term, do I want to own a company that has a higher growth element, higher cash flow, higher margin than consumer products company that has lower of each of the above. In the long run, I want to choose the one that's growing the most with the highest margins and the highest percentage of cash flow.
All right, stay with us. I want to talk to some reporters because I want to begin on this drop in yields that we mentioned at the very top of our program. Our senior economics reporter, Steve Leisman, joins us now. What do you think, Steve, is behind this today?
Couple things, Scott. The bond market waking up with a sharp drop in yields, and what happened here came from, I think, what looks to be a really lousy housing report, followed by an excellent 30-year bond auction that may have been helped by the lousy housing market, along with the drop in stocks. 10-year starting the day around 418 when the housing report came out, and along with that weakening stock market drove the first leg down in yields. You can see that, call it from 10 to about 1 in what the National Association of Realtors called a new housing crisis. Existing home sales plunged 8.4% in January. That was the biggest decline since the pandemic, twice the decline expected by the street. Some economists I talked to downplayed the surprise as more of a quirk in the data after a solid gain in December that you can see there. A solid 30-year auction, though, graded an A+ by my stingy grading colleague Rick Santelli. That gave yields a second leg down. That was in contrast to just a C on yesterday's weaker 10-year auction. All that led to a bit of a bump in the probability for Fed rate cuts, but the general story of a cut expected in June and a second one towards October or December, that pretty much remains intact. That those last two bars there are the same cut, just so you know. The housing numbers are worrisome, but they come on the heels of a strong jobs number and solid GDP data, so it's not by itself going to be enough to cause the Fed to push the panic button and move up any plans to cut rates, Scott.
It gyrates every day. You get a stronger than expected jobs report. Okay, no rate cuts. Yields move up. And then you get the weaker than expected housing report. Now we're back to, okay, now you're going to get rate cuts. It just shows the market doesn't have a really good idea where we're going.
Yeah, and I mean, for me, I look at all these factors and I put them in there, but really, it looked to me like the bond market was following the bond yields were following the stock market down. That to me seemed to be the bigger story of a flight to safety, along with those housing markets. I got to take that housing number in passing here, or in stride, Scott, because it's just too big of a drop, and some of the fundamentals look like they're getting a little better there. So I'm not really that concerned. You do have more room for the mortgage rates to fall relative to the 10-year, given what the Fed has done. We'll see if the market does that. You're still above 6 on the 30-year mortgage, so there is room for it to come down.
All right, Steve, good stuff. Thank you. That's Steve Leisman. Now to,
pleasure.
Wow, one of the worst days we've seen in a very long time for a trade that's been ripping higher lately, the transports. Our Frank Holland is following that and has more for us. Hi, Frank.
Hey there, Scott. You know, transports are on pace for their worst day since April 3rd. Following those so-called Liberation Day tariffs, trucking and brokerage stocks are by far the hardest hit. Take a look at C.H. Robinson on pace for its worst day since going public, with J.B. Hunt and Expeditors also lower. Some investors and analysts I'm communicating with, they call the selling just irrational and possibly caused by losses in other areas like software. However, a bear analyst is pointing to a blog post from a company called Algorithm Holdings as the cause. The company announcing an AI platform that would, in theory, allow smaller players to scale up without increasing headcount and potentially compete with larger public players. But broad selling on the transport's last check, only FedEx in the green as it has its investor day today.
Yeah.
Scott, back over to you.
5% on a day. You just don't see it that often. Frank, thanks to you. At this point, everybody knows about software getting smashed. Another pretty ugly day. Seema Modi joins us with that story. Hi, Seema.
We're off the lows of the day, as you mentioned, Scott, but the tech team at Barclays, they write that this narrative is moving too fast for positioning, using the words whimsical and flippant to describe the type of selling we're seeing today. Case in point, AppLovin, strong earnings, right? Revenue up 66% year over year. Upbeat guide. CEO Adam Farhoui on the call said the bearish view assumes that if AI makes games easier to build, the value of our ecosystem declines, but we believe the exact opposite. AI will dramatically lower the cost of creation, which means content will explode. Yet AppLovin down another 20% today. We are seeing some bright spots emerge in the last hour. Oracle is higher. Salesforce is down again, Scott. And take a look at its price to earnings ratio, now at 14 times. That is more than half its historic average of 30.
All right, Seema, thank you for that. That's Seema Modi. Finally, Apple shares looking, well, pretty rotten today. Steve Kovac with more on why. Steve?
Yeah, Scott, not just rotten, the most rotten they've looked since the Liberation Day fallout back in last April. So a couple things going on here besides that broader tech sell-off. I'll note a Bloomberg report yesterday that said that AI update to Siri that's going to incorporate Google's Gemini technology has been pushed back internally from what we're expecting in just a launch in just a few weeks. Now looks like it's going to happen in May. And not just that, according to this report, some of those features that were announced are going to be extended and launched in kind of sprinkles throughout the year, with the first tranche coming in May. So Apple tells me they're still on track to launch in 2026. That's all they've promised so far. But these internal delays are still kind of painting this picture. They don't have a grasp on artificial intelligence. And then one other thing that came in last night was FTC Chair Andrew Ferguson sending a letter to Apple CEO Tim Cook alleging that Apple News, the app that's on your iPhone, promotes liberal and left-leaning news sources while underscoring conservative news sources. No comment from Apple on that one, but just another sign that perhaps this White House isn't done antagonizing Apple, Scott.
All right, Steve, thank you. Steve Kovac. For more, let's bring in our panel. Invesco's Brian Levitt, Robinhood Stephanie Guild. Rich Saperstein, of course, is still with us. Brian, our reporters set the table perfectly for you to take your pick at any one of the dishes that are served up here, whether it's yields or the transports or software. What do you think?
Well, the first thing I want to point out is when we think about the big stories of last year, what people were so worried about, are people running away from U.S. assets? Is nobody going to buy U.S. debt? I think we can table that one, as I always assumed we would be able to. In terms of an AI bubble, look, the reality is there's some steam coming out of certain names as the market tries to determine winners and losers and is becoming more discriminate. But the Dow Jones Industrial Average is close to 50,000. The S&P 500 is close to 6,900. So, look, there is obviously some carnage underneath, but in general, this is not an AI bubble. The markets are holding up very nicely. In fact, if you look at leading indicators of the economy, they've generally been improving. Mm-hmm. The Fed should be lowering rates, in my opinion. So you're getting a shift in leadership, which tends to be appropriate at these points.
This passing of the torch that we've seen, as Piper Sandler put it today, what do you see?
Yeah, I agree. I wrote something recently where I said the cash cows are turning into cash demanders. You do have CapEx spending of a number of the hyperscalers increasing by 40 to 45%, and as a percentage of sales, by the way, not just outright. And then you have their cash flow yields. Actually, some of them are going negative. They're dropping by 80 to 100%. So in the short term, I think it's kind of warranted because I think the market has been relying on these companies to be these kind of cash cows, and it's flipping. And now we're looking for the new cash cows.
Right, I mean, it's kind of what you're talking about, but on the other side of it.
Quick point on yields.
Yeah.
So everyone's worried about tariff-induced inflation. Mm-hmm. Never happened, never pushed the 10-year higher. Now we're worried about it continuously, with rates possibly going down with a new Fed chair. Investors should own 10-year callable munis right now. I keep saying this, but 450, 425 tax-free yields are equivalent to 8.25%, 8.5%, 9% pre-tax equivalent. If the market sells off, you'll see this return into bonds. Yields will go down, prices will go up.
I always feel like, Brian, we're due for a pullback of some kind. We get a little bit. Everybody says, well, we haven't had one in a while. We get one, and then it's bought. For many of the reasons that y'all already laid out, as you did just a moment ago, the economic backdrop seems pretty good.
Yeah. And look, we had one of 20% last year, right? And people will always ask me when those are coming. They're usually the result of some type of policy uncertainty. And so we got it. And then a lot of the rest of the year was a movement towards greater policy clarity, and the markets took off along with it. So, this one's a little bit different. This one is more specific to, things like the software sector. But yeah, if you were to just not look at the market and just look at what's coming in from the economic data, there's an awful lot to like. I keep going back to last Monday when you got an ISM Purchasing Managers Index at 52. The new orders component of it was incredibly strong. The prices paid was essentially flat from the prior 3 months. I don't know if my compliance department wants me to say Goldilocks, but that feels pretty good.
Well, and then can you throw earnings into the mix? Earnings are ahead of
earnings
expectations.
Have been great.
Yeah, they have. Price action, not necessarily. with everything,
No,
but
I mean,
the earnings have been good.
Yeah, you have the days where you have like great earnings and the stock reverses the other way. But I do think expectations got pretty high. Like maybe it was the whisper numbers, but that's when you get a pullback. And I think we're just in the middle of a natural correction. Usually get them like 1 to 2 times a year, and that's where we are. I'm not worried about the medium term, but if everyone is positive, and AI is a real thing. Like I don't know about you, but I built 2 agents in the last week to help me do my job. So I don't think it's wrong to think that the economy and the way we work is changing. But I do think some of these things, especially in software, have been oversold.
But you do think that we're in the midst of some kind of corrective phase in the market before we rebuild and do something higher? I mean,
yeah.
Only 1 day's worth. I mean, we've been at 50,000 on the Dow. The equal weight S&P has been setting new record highs almost every day. It doesn't feel like that.
And I use the word correction, but I really just mean like a pullback of 3 to 5%. I think it's natural. We need to have these things. And the rotation is real. I think it is backed by real things. But on software, I would probably be more selective than the broad index.
Ideal portfolio right now.
Okay, tell me.
Okay,
yeah.
So
I hyped you up as like one of this country's top financial advisors. So give me the ideal portfolio.
Tapestry of AI-related stocks, the hyperscalers, independent power producers, and the companies that provide product to the data centers. Broaden it out with oil, consumer, pharma, maybe some other asset-heavy industries, just for the short-term performance, and couple that equity allocation with an allocation to municipal bonds. That's where we are right now, and that's what's going to work this year and into the future.
Quickly, does that sound good?
It does sound reasonable. And, particularly on this municipal bond point, I mean, you look at the state and local governments generally in good shape. Economies continue to improve. Tax equivalent yield of 8.5% to 9% if you're in a 35% tax bracket. I mean, that's almost equity-like returns without anywhere near the historical volatility. So that makes an awful lot of sense to me. And in terms of the companies that are going to be part of this AI build-out, I agree with both of my friends up here. The AI build-out is real, and there's plenty of businesses that are going to benefit from it.
All right, we'll leave it all there. It's good to see everybody, and thanks for coming here to Post 9. It's Rich, Brian, and Stephanie. Of course, we're just getting started. Up next, the Coinbase Countdown. That company reports earnings in overtime. Kate Rooney is standing by with the setup. We're live at the New York Stock Exchange. You're watching Closing Bell on CNBC. Welcome back. Coinbase reports in overtime tonight. Shares under some major pressure today. Ahead of that report, the stock is down more than 35% to start the year as Bitcoin has plummeted. Kate Rooney joins us now with a preview here. Kate?
Hey, Scott. So sentiment around crypto has really been the story for Coinbase. Robinhood didn't really help the crypto narrative either this week. Major drop in crypto trading volume, they reported to start the year. And then street earnings consensus has come way down in the past month, revised lower by about 159%. For the current quarter, Q1 estimates down 18%. So expectations going down. As Citi put it, risk-off environment remains particularly brutal for the crypto space, compounded by delays in a market structure bill in the Senate. Monis Hart downgrading Coinbase today, calling assumptions of a steady recovery were, quote, foolish given the typical length of a crypto bear market. Long run, they are bullish, just waiting for a better entry point in this particular stock. Coinbase bulls, though, they're looking at derivatives growth, stable coin adoption, and then revenue diversification overall. Citi does also point out category leader here for Coinbase. They are going to see more competition going forward as you see more traditional brokers really looking to get a slice, potentially putting some pressure on pricing, Scott.
I mean, the analyst who was on the prior hour thinks that what's happening in crypto might just be getting started, which is not going down. Yeah. And that would not bode well for this name.
And you've seen the same thing with Robinhood, Scott. When we talked to Vlad Tenev, he was sort of saying, there's perception versus reality. It is really hard to break out of trading like a crypto proxy. And Robinhood is less than 20% of revenue from crypto. Coinbase really is a pure play crypto company. So a long-term sustained bear market in crypto, not great for Coinbase. Even if they are able to show a little bit of diversification and revenue, it's sort of an uphill battle to defeat that perception that it is just trading right alongside Bitcoin. So, Brian Armstrong, the CEO, has his work cut out for him in terms of telling that story and really hammering home the diversity of revenue, if that is the case, and they're able to sort of move away from trading. But at the same time, there's so much more competition as this asset class becomes a bit more mainstream.
Yeah, no doubt. Kate, thank you. That's Kate Rooney.
Thanks, Scott.
Our next guest actually sold Coinbase last week. Joins us now, Bill Baruch. He's the founder and president of Blue Line Futures. So we mentioned, the stock is not just a today story. It's been in a steady decline as Bitcoin has had problems. You saw that and had enough?
Yeah, we tapped out last week. You mentioned that on the show on halftime. And the thing here is like the host said a minute ago, that it's like a crypto proxy. And we looked at it as getting additional exposure to Bitcoin. They hold, at middle of last year, $1 billion, $1.25 billion of crypto assets on their balance sheet, and they're unhedged. So for us to look at that and see, at the time we were beat on crypto, but the fact that Bitcoin broke 75,000, it does open the door to lower, I think 50K at least, and we could see further pressure. Now, and you look at the Robinhood numbers last week or earlier in the week, the transaction volume was down, I think 38%, and transaction revenues decreased, and I think that's going to hit Coinbase quite a bit. So fairly negative right now on what we could see from here, but at the end of the day, a lot of that negativity started to get built into the market too.
I mean, you sold IBIT too, so you're not just relating this bearishness on the asset class, if you will, to a singular name of a stock.
Yeah, we looked at Coinbase as a proxy to Bitcoin and owning it when things through this cycle. The cycle is going to have a pullback, and we looked at the end of October as potentially seeing a rebound in Bitcoin. We like the idea of the stablecoin tailwinds that could be there. That legislation, if you look at a Coinbase chart, that fell through in January. That's really when this stock started to see additional pressures. So 75,000 Bitcoin was our line in the sand. We tapped out there, and really, from a broader perspective, we rotated and found other names that we wanted to own within that. From there, outside of that asset class. But I think what you have to look at here, again, they're owning unhedged Bitcoin on their balance sheet. There's going to be transaction volume that's going to decrease within the environment that we're seeing in crypto right now. And it's going to be pressures that can build, and it may not see a turn until you get an upbeat earnings report or actually a turn in crypto. And the bottom for this could be 50K, if not quite a bit lower. So, we're going to hold our breath and stand away from it.
Yeah, you and a lot of others. There's no doubt about that. I appreciate you joining us, documenting this for us. Bill, thanks. Bill Baruch. Still ahead, Inside Wealth, exclusive new CNBC data revealing the most active family offices of the past year. The details are coming up right here on Bell. Welcome back. CNBC releasing its inaugural Inside Wealth Family Office 15 list, ranking the most active large U.S. family offices by disclosed deal activity. Who else but Robert Frank joins us with that exclusive data. Tell us more.
Scott, great to see you. Well, the family office of Eric Schmidt, in fact, topping the first ever Inside Wealth Family Office 15. So this list was developed with exclusive data from Fintrix. They are the private wealth intelligence platform. So it ranks family offices with more than $1 billion in assets according to the number of startup investments they made in 2025. So it's really highlighting the most active deal makers in the $3.5 trillion family office space. Schmidt's family office, called Hillspire, made 15 startup investments last year. Most of them are in AI, and that's not surprisingly for the former CEO of Google. Many of those are linked to former Google or Alphabet executives. They include a Paris-based AI voice startup, a fusion company, and a software platform for luxury travel and experiences. Jeff Bezos ranking second with his Bezos Expeditions family office, making 14 investments last year including an AI robotics company and a company developing more energy-efficient AI compute. Other big names on the list include Laureen Powell-Jobs, Peter Thiel, Stanley Druckenmiller, Barry Sternlicht, and Walmart heir Lucas Walton. His Builder's Vision family office is investing in sustainable agriculture and a lot of green energy companies. For the full Family Office 15 and where to find out where today's billionaires and biggest family offices are putting their own money, you can sign up for the Inside Wealth newsletter at cnbc.com/insidewealth. Scott?
All right, interesting stuff. Robert, thanks for that. Robert Frank. Stocks, as you know, they are lower. Dow's down about 500 off the lowest levels, but nonetheless, it's a tough day on the street. Up next, Trivariate's Adam Parker. He'll tell us how he's playing today's action, or at least how he sees things going from here. Show you the major averages here. NASDAQ down about 2% as we edge towards the close of the day. Dow's down 1%. Now the S&P's down 1 1/3, and it is the Russell down almost 2% as well that has our attention today. Let's bring in CNBC contributor Trivariate's Adam Parker, who joins us now. It's good to see you. I mean, this is an interesting day in that it feels like this is like a growth scare kind of a day, but yet people are so positive on the economy. I have a hard time believing there's durability behind that, but we got a bid in treasuries, a bid in the dollar, dramatic decline in the transports, all these sort of economically sensitive areas, and some nonsensical moves.
Hi, Scott. So I think there's a couple things going on. I think one is, in the institutional meetings, I was just out, like you, I was just out on the West Coast for a few days meeting with a bunch of institutional investors. And every meeting, people are trying to figure out what is the next sector that I thought was impregnable to AI that maybe isn't. I didn't have on my bingo card, it could be Schwab or the insurance brokers or, CHR. So people are sort of, kind of, I think, a little bit surprised in a rolling fashion about what AI is disrupting. So that's one, I think, vector. And I think the other vector has been in the last couple weeks that the administration can kind of come in and create short-term volatility, whether it's in credit cards or home builders with antitrust or other stuff. So I think people are a little bit more on edge about the durability of the business model. And so that historically, when you have uncertainty, usually you just get lower multiples.
I mean, it feels like we're shining the flashlight in every corner of every industry, waiting for some cockroaches to run out and say, AI is going to be a problem for us. To your point with the brokers, it's the private credit names first, and then it's some of the brokers, and then some of the financial, information names. It's like ticking them off one by one.
I think a useful exercise is pretend you're the CEO of a huge company and say, okay, who am I paying a lot of money to? Who's making a high margin off me? And can I do anything to get rid of it? So all of a sudden you look at S&P GI or MSCI, FactSet, Gartner. You're looking at the software companies saying, maybe I don't want somebody to earn 80% margin off me for the next 10 years. So that's like one vector of thought I think investors are thinking about. And then the other, of course, has been and remains, what are the low margin businesses that have lots of employees where maybe I can predict my employee and customer behavior and drive out costs? So I think there's like a different, I would say, feel to what's happening in the market right now, where maybe this isn't just the economy's awesome, but maybe it's a lot of these stocks are pricing in a durability to their revenue stream that now seems a little bit more in jeopardy. Our main call at Trivariate coming into the year was, I think there's a harder time the price to forward earnings expands than it contracts. And I think this day, these kind of days are an example of why I still think that's true.
You think the software thing is overdone? I know you haven't been in favor of it, but I mean, isn't it starting to get, in terms of some of the names and how much the multiples have compressed, a little ridiculous? I think I saw something earlier that like Salesforce's historical PE is 30, now it's down to something like 14.
So I'm gonna say yes and no, meaning like there could be a short-term bounce that's powerful higher for the names. A lot of them are in in ETFs that trade alike. But when you start really looking at the valuation of individual names, like Salesforce is a good example of a company where they've generated a lot more cash from issuing their employees options than they have from selling software. That 14 times number is not a GAAP number. When tech outperforms, nobody cares about options issuance. When it underperforms, they care a lot. One of the things I think is really interesting, Scott, is if I said to you, what are the businesses and software that are least likely to be cut by IT heads at big firms, you probably say security, right? So you look at Palo Alto Networks or FTNT or whatever. Or maybe in the semiconductor space, I always have a positive bias there. You'd say the electronic design automation businesses, Cadence and Synopsys. Well, guess what? Those trade at way higher multiples. So are they more expensive and you want to buy the cheaper ones? I don't think so. I think the cheaper ones are cheaper for a reason, which is that the market is saying the long-term prospects for those businesses are probably worse, or in the distribution of outcomes, zero is an outcome for them. So I'm not sure I want to use valuation as my reason to buy the software companies that sold off. I might buy the more expensive ones, just thinking the market's probably right that they're more sustainable.
What about this passing the torch idea, that's what we're in the midst of, and it can get a little dicey at times. It can feel a little swervy as you're moving around, trying to figure out, where this bumper car is going to go.
Yeah, I think that's true. One of the things about semis that I like is there's 4 or 5 different things in there. And so if I get worried that the AI revenue beneficiaries aren't going to have multiple expansion, or I worry memory's oversold, I can go buy some industrial semis, or I can buy some semi caps. So I think there's things to own. I still think the sector, and there's, I can predict your pushback, but I think the sector I'm most excited about in a medium to long term remains healthcare, because I think there's so many opportunities for efficiency improvement, predicting employee behavior, predicting customer behavior, driving out costs, driving margin expansion, helping people live longer and be more productive while they're alive. And I think the stock market is telling me, hey, Adam, 0% chance we're the best performing sector in healthcare in the next 5 years. And I think it's 30 or 40% chance. And so, yeah, I'm going to invest where I think the probabilities are underestimated.
All right. We like the contrarian call. We'll talk to you soon. Hopefully back here post 9. Adam, thanks.
Yeah, man. I'll see you soon. Take care.
All right. Adam Parker. Up next, we track the biggest movers into the close today. Christina Partsinevelos is standing by with that. Hi, Christina.
Hi. Well, we have a tale of 2 tech stocks. One sinking despite an earnings beat as investors really weigh AI risks. You guys talked about that. While another is pacing for its best day on record after blowing past estimates. We'll have those movers next.
Are we less than 15 from the closing bell? Back to Christina now for the stocks she's watching. Please tell us.
Shares of AppLovin because they're sinking right now, roughly 19%, despite beating fourth quarter profit and sales estimates, as investors just remain jittery about AI's potential impact on the business. Just keep in mind, on Monday, shares actually surged 13% after a short seller retracted its report accusing an AppLovin shareholder of financial crimes. The stock, though, is the Nasdaq's worst performer today. Fastly shares skyrocketing 70% right now, pacing for his best day on record after blowing past Q4 estimates and highlighting continued momentum from AI tailwinds. The cloud platform operators' earnings came in at twice the street's estimates, hence why you're seeing this 71% swing right now. Those results are also lifting Fastly rival Akamai. Shares gaining 10%. The two companies compete in the content delivery network market along with Cloudflare. Citi said in a recent note that Akamai's budding AI narrative isn't fully priced into the shares. The company's next earnings report is due a week from today. Did I screw up that name, Scott? Akamai.
No, I think that's just fine.
I don't know why I'm doubting myself after yesterday. I think I said something wrong. All right.
I think you did great.
Thanks.
We'll see you tomorrow.
Bye.
Bye. I'm just checking the zone. Oh, no, you're in the market. No, are you in the market? Yeah, you're in the market zone. We'll see you in a little bit.
Yeah.
I think you are.
Yeah.
Who knows? We'll see. Maybe not anymore. I don't know.
Oh!
All right. Up next, we get you. We're in the market zone next. How about that? We're now in the closing bell of Market Zone. Mike Santoli and Empower's Martin Norton are here to break down these crucial moments of the trading day, plus your big earnings setup. Look who it is, Christina Partsenevelos watching Applied, but you made it. Watching Applied Materials, Mackenzie Segalis on Airbnb, Julia Borson's tracking Pinterest, Contessa Brewer is sitting next to me, not really standing by, she's sitting next to me with what to expect from Expedia. At any rate, Michael, you first. What do you think?
Yeah, I mean, at least for a day, the market seemed to run short of hiding places. I mean, we've been talking so much about the way this market's been managing to just sort of find an answer to every pocket of weakness and stay supported and have the S&P more or less stay in this range. Not enough today. I mean, seeing a little bit of green shoots, if I want to squint and say Microsoft didn't make a new low and maybe first in, first out in terms of what started this sell-off. But it does show you that we're on the defensive a little bit, and with the yields being compressed after that existing home sales number, it just sort of scrambled the script a little bit, I think. And so for now, I still think you have a situation where market breadth has been good. Earnings have absolutely done their job for the most part, but none of that has been enough to really restart upside momentum for the index as a whole. And so I guess today's raising the question of whether we're going to just need a little more of a step back, pull that slingshot back, maybe get oversold in some pockets before you can really get higher.
Yeah, well, you'll be all over it. Top of the hour, as always, with Mel. We'll see you then on Overtime. It's Mike Santoli. All right, Christina, Applied Materials. Chips were at a record high, but not so much today.
Yeah. Wall Street, though, for this name is expecting a beat and a raise for the quarter for one of the world's largest chip manufacturing equipment makers. You can see just a sea of red, down 3%, but the bar is relatively high. The stock is already up roughly 28% this year, outpacing the S&P 500 as well as the SMH. The key debate, though, is around the outlook for chip equipment spending in 2026 and whether management sounds as bullish as some of its rivals did when they reported, like Lam Research was upbeat, KLA was maybe just a little bit more cautious. So which way does Applied lean? The company typically doesn't give an explicit industry forecast, so investors will be reading between the lines on any commentary about the next few quarters. The other theme to watch, memory. Applied has strong exposure to DRAM and high bandwidth memory, which analysts say could be a meaningful tailwind as AI demand accelerates into the back half of the year. Scott.
Did notice that Micron was up today, as a lot of other stuff was red, so we'll see. Christina, thank you so much. That's Christina Partsenevelos. All right, Mac, Airbnb, what to watch for?
Q4 print is a tug of war between steady travel demand and the AI disruption narrative that has dragged down the online travel group. Citizens is leaning bullish on demand, upgrading the stock with a $160 target, roughly 40% upside from where it's trading right now. They like hotels showing up on the Airbnb app, which could lift conversion in supply-tight urban markets. Analysts also believe Airbnb is less vulnerable to AI cutting it out of the transaction because many of its listings are unique and insulated from LLM and agent risk, given you can't just reroute that inventory through another platform easily. The Street anticipating modest Q4 upside from stronger last-minute U.S. bookings and the global rollout of Reserve Now, Pay Later. But the real swing factor here is guidance, how confident management sounds, and whether margins get pressured as investment ramps. Scott?
How about Pinterest, Julia?
Well, Pinterest shares are down about 3% ahead of reporting after the bell, and they've been trading today at their lowest level since 2022 on earnings misses as well as weak guidance. Now, this quarter, analysts expect 15% revenue growth and 23.5% EPS growth. Morgan Stanley, with the buy rating on the stock, writing, the issues are not limited to macro, as we believe the macro impact is exacerbated by the lack of breadth and depth of advertisers bidding in auctions on the platform. So now investors will be looking to understand how Pinterest's AI investments and shopping initiatives are paying off. Another key topic, the company's major restructuring announced in late January, including cutting less than 15% of its workforce and pulling back on office space as it directs more resources towards AI. So I think we're going to hear the word AI a lot of times on this call, Scott.
Yes, I'm sure we will. Julia, thanks. To Contessa sitting next to me, as I said. What about Expedia?
Yeah, well, Expedia shares had soared after the last earnings report when it raised full-year guidance and talked about the strength of the travel market. But since then, you've got stocks down 17% over the last 3 months. Look, the Street's going to be listening for updates about the B2B part of Expedia's business and how the switch from online search to AI-assisted travel planning is affecting that business. You're going to hear a lot of AI here, too. TripAdvisor reported today that the switch has pressured its business, and look at its stock.
Wow.
down almost 16% and missed expectations. They say that there's a real decrease in customers because of the way search engine optimization is changing. And then you saw Booking and Expedia stock down about 3% or so lower as well.
All right, we'll see what's delivered. Contessa, thank you. Contessa Brewer. All right, Marta, what do you make of this day? It's, I don't know, we're close to the lows, if not there, on, I think, everything.
Yeah, it seems like whack-a-mole is just continuing. I really like the point that was made that we're in earnings season, earnings delivered, but I think what investors are questioning is not earnings for 2026 or guidance for 2026, but what the terminal value is now that we have AI acting as a bit of a disruptor. And I can't help but look at this as opportunity when we consider how overvalued the market has been.
Oh, you think the market's overvalued? Why so?
Well, it's been, when we take a look at across sectors, even in areas that have been forgotten, at least in 2025, areas like consumer staples, and we look at their forward price to earnings ratios, they're in the 9th, 10th deciles. That's true for the S&P and true for most sectors. And so now we're starting to see some dispersion and some opening up of that, some opportunity.
Interesting. When you look at what's happened, let's say, with industrials and transports, what do you see there? Because the equal weight S&P, as we've said, for good reasons, been making these new highs. So many things outside of tech have been driving it.
Right. So really, it seems like 2026 is a reversal of what worked in 2025. So you definitely have that cyclical surge where you have areas like energy, materials, industrials doing well, but then you also have areas that are kind of defensive. Consumer staples comes to mind that are also surging ahead in 2026. So it seems like whatever investors were shunning in 2025, they're turning to in 2026. I just don't know if they can make the valuation argument there.
Do you think software is overdone?
I mean, I do think if you're looking at software and you think AI is taking over the world and AI is going to live in buildings and people are going to be kind of sleeping on their couches, then yeah, maybe software is done. But if we're looking at software as an infrastructure play where it has the data, it has the workflows, then yeah, I think maybe AI takes a little bit off the top, but I think these companies still have some durability. So I'd be looking in that space.
Wow. I guess there's a lot to look at because so many have done so poorly. It's hard to figure out, right? It's hard to figure out what's what.
That's right. I think that's the big question. I think one of the concerns I have is the easiest route to software is just to buy a software ETF. But it does seem like you need to have a discerning eye.